An update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hakis. Yahira.
Hi, Lisa. The crypto sector is closing in on another milestone. The SEC signed off on a proposal from the CBOE, NASDAQ, and NYSE to launch the first ETFs for the Ether token. Fund managers still need approval from the agency before they can launch products, but investors are eager to test whether the second biggest digital asset can draw similar demand to Bitcoin. Bitcoin ETFs had their historic debut back in January and have since amassed $57 billion in assets. The Ether token is up nearly 20% this week on the heels of the news. Nomura's top executives are getting big raises. The Japanese bank more than doubled pay for its top managers as earnings rebounded thanks to the booming domestic market. Total compensation paid to the firm's 8 executives officers rose 150% to more than $28 million. The total pay for Nomura's top managers is the highest in at least a decade. And Citigroup, HSBC, and Barclays want bankers back in the office 5 days a week. The banks have been known as the most flexible Wall Street firms when it comes to allowing employees to work remotely, but regulatory changes will make it trickier for the banks to allow that, as the Financial Industry Regulatory Authority, known as FINRA, will reinstate pre-pandemic rules for monitoring workplaces in the coming weeks. That's your Bloomberg Brief. Lisa?
Yahira, thank you. Heated debate around the surveillance table about working from home. Emery, you want to let us all know how you feel about this story?
I just can't believe it is 2024, May of 2024, going into the summer, and now they're deciding to get people back to work. Why weren't they there before, 5 days a week?
Because they've completely reshaped their lives, Emery. I'm going to take the opposite on this. People have moved out of the cities. They've gone to the suburbs because they were allowed to work from home, and now they have to, commute 4 hours in? That doesn't seem nice.
And just to be clear, it's not back to work. I mean, they've been working. You think they just go home and twiddle their thumbs?
Fair. Back to the office.
Okay. I will say, though, it is sort of funny to blame FINRA for this, but it's clearly maybe something else. Up next, diverging economies.
There are divergences across the different economies, which mean that there will be different monetary policy responses. But overall, I mean, we think that overwhelmingly, the monetary policy settings will remain restrictive for some time.
That's coming up next. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Conversation has continued about work from home versus in the office, so we will leave it there. Welcome back. We're looking at a market that's trying to claw back some of the gains from yesterday's losses. Amazing to think that yesterday was the biggest sell-off going back to the end of April, it was an entire 0.74% decline on the S&P, on the NASDAQ. This to me is sort of shocking, Danny. It was down 0.4%. Nothing really dramatic here. And yet we saw NVIDIA gain something like north of 9% for a market cap gain. This to me of $218 billion.
Yes, and then this gets back into what you and I were talking about, Lisa, of just how much more wealthy Jensen Huang is now, and what do you do with all the money? If I can go there, what are you going to do with all that money? You're going to buy assets. And I think that's part of the reason when you see declines, Lisa, they're not as big as they were, because a wealthy person, when markets get cheaper, they're going to buy. When milk gets cheaper, they're not buying more milk. This is where the concentration of wealth is going.
Basically, asset price inflation as people deal with the fact that if you have, you know, $30 billion, $40 billion, you're not exactly going to just buy a new yacht. You got to look a little bit broader than that. So today, maybe that's what's lifting valuations. Jensen Huang in the market buying, just saying that is not actually true. Meanwhile, in the bond market, you could see a bit of a bid in after yesterday's sell-off, and what you could see over in the commodity space is a bit of a dip. This to me is one of the biggest questions, Anne-Marie. The idea that crude's off about 0.75% as people were talking about how this might be sort of one of the bigger surprises, commodity shock. It looks like it's not on the table.
Well, we're seeing that in copper prices, not exactly seeing that in the oil prices. But we saw the lift in oil prices had to do with geopolitical risk. Some of that has now calmed down, but we still are going into this peak driving season in the summer, and people are expecting a little bit more, at least when it comes to gasoline prices. We're going to be speaking to an analyst, part of Gas Buddy, who is actually tempering some of those risks people are talking about, thinking $5 a gallon. I think he has a little bit more of a muted response to that.
I'm really looking forward to that conversation, by the way. I love the idea of analyzing some of the gas station placards to really understand the direction of travel. Under surveillance this morning, diverging economies.
Across all major economies, inflation is heading down. Of course, I mean, there are divergences across the different economies, which mean that there will be different monetary policy responses. But overall, I mean, we think that overwhelmingly the monetary policy settings will remain restrictive for some time.
Here's the latest. Traders pushing back Fed rate cut bets. Atlanta Fed President Raphael Bostic, the latest official to reiterate the higher for longer narrative, saying, quote, the sensitivity to our policy rate, the constraint and the degree of constraint that we're going to be put on is going to be a lot less. I would expect this to last a lot longer than you might expect. Meanwhile, the ECC's Joachim Nagel says the likelihood of a June cut is winning traction. Ian Shepherdson of Pantheon Macroeconomics joins us now. Ian, you have somewhat of a contrarian view, and I think this is sort of interesting, where you push back on this idea that maybe this is a less interest rate sensitive economy, and that basically you're looking at something of a lag effect that's going to take effect much later. Ian, can you talk about why you just downgraded your forecast for the U.S. economy?
Yeah, you know, we've taken a long, hard look at the operation of policy through the economy. We're particularly interested in the small business sector, which is very bank credit dependent. And bank credit growth in the U.S. has essentially stalled. It's become quite difficult and very expensive for small businesses to borrow. And that's being reflected in their surveys. You know, small businesses are telling us they can afford to carry less inventory. They want to carry fewer people. They're cutting back on their capital spending. And these businesses, you know, they employ 60 million people in the U.S. They're extremely important. But in the market, they tend to be very much kind of disregarded because all the focus is on the large corporate sector, on the quoted public companies. And that means that you can get kind of a stealth slowdown in the small business sector, which goes more or less unnoticed until it spills over into things like the payroll numbers, which ultimately, you know, is everyone's kind of bellwether of what's really going on. And payrolls have been great, but they're now starting to soften. And the Small Business Service and the NFIB, which has been running for decades, is telling us pretty clearly that we should expect substantially weaker payroll growth over the next few months. And I do think there's a very good chance that that will start to shift opinions back towards the Fed having to do more and starting earlier.
So, Ian, how much is this sort of ratcheting down in your GDP forecast predicated on the idea that Raphael Bostic is sort of setting the tone at the Fed, that essentially they are going to hold rates higher for longer, and that is going to be ultimately what leads to 2025 slowdown that's deeper than people expect?
Well, I'm more concerned about the lagged response to the tightening that they've already done rather than the higher for longer. I mean, obviously, higher for longer is, in my macro story is not great, but the problem for growth that I see going forward is more because of what they've already done. And I really think that markets and the Fed underestimate the length of the lags. If you look back over history, the response from the small business sector to Fed actions often takes 2 years. Now, it is 2 years now since they started raising rates. And so we ought to be seeing that softness beginning to come through. And it's right there. It's in front of us in the small business survey. So I kind of think even if the Fed starts cutting tomorrow, a slower economy is baked into the second half of this year and most of next year, more or less no matter what. But I think it's also important to draw the distinction that slow doesn't mean catastrophic or recession necessarily. It just means slower than markets are expecting and probably slower than is priced into earnings forecasts, which is where things get interesting for the stock market. Having had such a great run, we're hitting consistent record new highs. I just wonder whether the earnings numbers that rally has been based on for next year in particular are actually realistic. So there's some points of pressure here. I don't think, I don't want to sound super bearish as though I'm talking about the economy really rolling over. I'm not. But I just think the scope for disappointment and the scope for the Fed in a few months' time saying, hey, actually this is rather weaker than we thought it was going to be at this point. So let's bring back some of those rate cut expectations. That seems to me a realistic, reasonable scenario at this point.
But Ian, to your point, if they cut tomorrow, it won't make enough of a difference because we're going to see the lagged effect of what happened 2 years ago. So does that mean if we do adopt the Bostic stance that we are higher for longer, and let's say we don't get cuts until 2025, is that a policy mistake? Yes, I think it is. I think it is. The Fed has raised rates by more than 500 basis points. Real rates are high. And the U.S. economy has no demonstrated ability in the recent past to live with real rates at this sort of level for an extended period. I mean, we did in the late 1990s, but that was during an astonishing tech boom when productivity growth was running at 3% plus. We're not in that position now. And so I don't think the economy can take that sort of level of real rates, especially because the fiscal boost that we enjoyed in 23 is now pretty much over. You can see that fairly clearly in some of the data now. So we've had these, we've also had not just the delay from the monetary policy pass-through, but also a fiscal boost as well. And so this year and into 2025, we don't have either of those supports, and the pressure from monetary policy becomes more pronounced. So delaying, if they don't cut until 25, then I'm going to start thinking hard about how weak growth is going to be in 26. Things work very slowly. We're all very impatient. Everyone in markets, media, Fed, everyone's impatient. We all want things to happen quickly. We want the Fed to hike on Monday and the economy to slow down by Friday, and it just doesn't work like that. And the danger is that we kind of forget what they've done, and then we wake up one day and go, oh, look at that, payroll growth is down to 100,000 or 50,000. Didn't see that coming. Ian, I fear impatience is simply just human nature. You said that we're not going to have the 90s productivity boost that we did from the internet, but we have AI. Why aren't we getting another round, as Jensen Huang calls it, another industrial revolution that is going to lead to productivity boosting? Yes, I think it is, absolutely. And I'm very much an AI bull. But I'm not sure it's going to be as transformative as Internet 1.0 was quite as quickly. With the birth of the Internet, or the more widespread adoption of the Internet in the mid-90s and onwards, it was very much being pushed from the ground up. People loved email, they loved online shopping, they loved the birth of Amazon. All these things generated immediate and obvious benefits for individuals, and so they adopted them with great enthusiasm very quickly. I'm not sure AI is the same. I view it more as being pushed down from the top by the corporates, pushed down through the business sector, rather than adopted very rapidly from the ground up by individuals. And so I'm very clearly, we've added a kind of an AI premium to growth, if you like, that we wouldn't otherwise have had relative to the interest rate environment, because we are bullish on it. But I'm just not willing yet to say it's going to be as transformative as quickly as Internet 1.0 was.
Ian Shepherdson of Pantheon Macroeconomics, thank you so much for being with us. I will just say, this idea of talking about AI, Emory, and what the implications are going to be sometimes feels a bit like crystal ball kind of stuff.
Yeah, exactly. Also, could we pick up with the point when he said fiscal policy? Maybe it's dried up, but when you go into 2025, at some point, there's going to be big discussions on adding more to the deficit, spending more. Well, how do you pay for tax cuts? That's what the conversation is.
Well, and I'm glad that you picked up on that point, because I perked my ears up when he said that as well. And I thought to myself, What about the argument that a lot of the fiscal dollars haven't yet been deployed and still have yet to circulate through the economy? This is actually a point of big debate, and we know that other people have some views on that too. Coming up next, Jay Pulaski of TPW Advisory, Aaron David Miller of the Carnegie Endowment for International Peace, Helene Becker of TD Cowen, and Terry Wiseman of Macquarie. You can see a lift to end the week, maybe a little bit of optimism for a long weekend ahead. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
For this year, the Fed probably will see that slowing in inflation that it wants to see.
We're on a track to, mid-3 core inflation by year end, maybe a little bit lower. The Fed's on the right path.
Our baseline forecast is we will get 1 rate cut this year, probably in December.
Our call remains, as it has been for quite a while, first cut in December.
The Fed is going to hold the line on that and make sure that we're coming back to 2%. Things can downshift here pretty quickly as we go forward.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
So we've had a dose of cold water to start the show. Now, let's bring in the bulls. Welcome back. This is Bloomberg Surveillance from New York City for our audience worldwide. Anne-Marie here. We've got Danny Berger in instead of John Farrow, who started his weekend early, which is a wonderful thing. I gotta say, we've been hearing about push back your expectations, Ian Shepherdson pushing back some of the high optimism around economic growth. Danny, how much is this just that people have no visibility whatsoever into just whether AI is going to continue and how much we can continue to see this kind of lift to the market?
You saw that definitely yesterday because NVIDIA had a good day and the rest of the market did not follow on. It seems to be some skepticism. Can AI lift all boats? But it also just might be, Lisa, you were talking about this, the exhaustion of the market. Recall that we just had basically every bear, save for Marko Kolanovic, finally say, you need to buy. Finally say, even Mike Wilson, I don't know what's happening in this economy, but I'm still going to upgrade my target.
Momentum gonna momentum. At the same time, you do have a question, Anne-Marie, of how much the Fed could curtail this party versus just continue to fuel it. We have Goldman Sachs just coming out and seeing the first Fed rate cut now in September versus the previous call of July. This just sort of speaks to the momentum in the market, which is the Fed is not gonna have justification to cut rates quite as much as people thought.
Higher for longer. We've heard a lot of Fed speak this week. Yesterday, once again, we also heard from Raphael Bostic talking about how in the first quarter of 2024, inflation went sideways. That was supposed to be this moment for the Fed, this disinflationary story. It didn't quite go the same way. They need more time. But what I take away at the end of this week was not just Adam Posen, but our guest in the last hour, Lee, talking about potential, now a serious tail risk of a hike for 2025.
And you saw that in the minutes too, that they said, look, we do need, if the data warrants it, various members said that they would look at a hike. I think one of the striking things, listening to Bostic, for example, is Oxford Economics points this out. There's a growing divergence between what regional bank governors are saying, which is more hawkish than Fed and the governors in DC. They are remaining more, we have this bias to cut. As the divergence grows, I wonder if Powell is going to get pushback on this cutting bias. If he wants to cut this year and cut sooner, are we going to have folks like Bostic saying, we can't do that?
Are we going to have dissent? Right now, you don't have dissent in the market. You basically have trying to claw back some of the extreme losses. 0.75% decline yesterday in the S&P. Today, you're up about 0.3%, higher at the session highs, 5,300 exactly. What an even number. Meanwhile, you do see a bit of dollar weakness in the Eurozone, a bit of skepticism about not whether they can cut rates in June, that seems to be a lock, but just how much more they can cut this year. 10-year yields basically unchanged. I mean, honestly, can we really call this any movement whatsoever? And crude dipping just a bit because, I don't know, try to understand exactly what's going on in the commodity space. Good luck, because whatever narrative it is seems to rule the day. Coming up, Jay Pulaski of TPW with stocks coming off their worst day in 3 weeks. Elaine Becker of TD Cowen ahead of the busy summer travel season. And Terry Wiseman of Macquarie as rate cut bets are pushed back now to December. We begin with our top story, stocks coming off their worst day in 3 weeks despite massive gains from NVIDIA. Jay Pulaski of TPW, a resident bull, writing this: NVIDIA's results reinforce our recent focus on paying attention not to the news, but to the reaction to the news. The stock's 10% gain tells us investors still underestimate the speed, scale, and scope of the AI age. Jay joins us now. Jay, wonderful to see you. Love having you in the studio. Can you talk about just how much in the crystal ball discussions that we've been having about artificial intelligence, why you think the price action shows we're just not bullish enough?
Well, I think the market tells us that, right, with the reaction to the news. The fact that the stock is up 10% on the day tells you it was a positive surprise, just by definition. And so, and it was. I mean, it's super impressive, right? I mean, you have to admit, a tripling of revenue and a sevenfold increase in profits year over year. I mean, that is just, you know, it's unheard of. And so you have a 10% move, and then you don't have the rest of the market responding. As was discussed just a minute or so ago. But to us, look, we're believers, right? We are believers that every company, every government in the world is going to have to participate in the AI age. And it's either you participate or you lose. And it's that simple. And there's this concept which we believe in, which is called sovereign AI as an example, which basically states that every country is going to want its own AI. So you're just talking about a massive global explosion of demand, and you're seeing that with NVIDIA.
Although you're seeing it with NVIDIA. They're the winner.
Yes.
And it's a question of, can they basically rise all boats, or is it going to be NVIDIA's game and party, and only NVIDIA's game and party, as they potentially take share from AMD, from Intel, from a lot of other companies that otherwise might be getting some of these dollars?
Look, we're believers in what we call the pick and shovel thesis of investing in this, right? We want to be in the digital pick and shovel, and for that means for us rather semiconductors, okay? Because they're needed for the whole process. They're the winners of this, to your point. And whether, you know, X company versus Y company is a different story. To us, it's quite simple. As an investor, we want to be in the pick and shovel. So in the pick and shovel in the digital age is the semiconductor space. And then the pick and shovel in the physical space is the miners, because what's really interesting, and you touched on it with commodities earlier, what's really interesting is you're fusing the digital and physical worlds through the power demands for the data center build-outs. And again, I mean, I think the CEO of NVIDIA is a guy you have to pay attention to. He is at the forefront of this. He's like Elon Musk was a couple years ago with EVs, right? He was on the front end of it, and so he was seeing what was coming. And Musk was right, okay? So now you follow the CEO of NVIDIA, and he's talking about the factories of the future. He's talking about the data centers being the modern factories of our world as we move forward, and they need power. So I'll just give you an example. You know, natural gas, UNG, up 40% in the last month, 40%. Before that, it was copper. Copper, because you need copper for the electrification and the power generation, which again is going to be global. Every country, every region. So it really feeds into our tripolar world thesis of regional deepening and regional integration in Asia, Europe, and the Americas. And you see it. The Europeans are building out AI. The Chinese are building out AI. The Americans are building out AI. Everybody has to have it, and they have to have it now. And then the last point I would make is that, and I'm a believer in this idea, is that this is going to come much faster. So I respect Ian earlier, and he was saying with AI, he's not sure how it's going to come through. My feeling is that the infrastructure for AI has already been built out.
Right. Well, can I just defend Ian for a moment? Because part of his thesis was for the
Usually there's like nothing but silence. I mean, wait a second. Come on. Where's John?
Yeah,
John.
exactly. I'll take the combative view if John's not here. I'll try my best.
That never happens then. I'm like,
my accent isn't keeping up with it, but my combativeness, I'm trying, Jay.
Okay, no, I'm game.
Okay, so Ian's argument is basically that it's not going to be adopted as soon, specifically with companies. Because if you think about the internet boom, you know, everyone and their mother could simply sign up to the World Wide Web, get their own website, and then there you go, you take off. Integrating AI is a much more complicated and longer process.
Okay, the pushback is that it took a decade or more for the internet to be built out, because every piece had to be created from the start. The point of the AI age is that it's a layering on. The infrastructure is already built out. And so it's going to accelerate much, much more quickly. So I'm in the it's going to accelerate much more quickly camp. Ian can be in the other camp. We see how it plays out. And I go back to the idea that every company is going to have to participate in this. Every country is going to have to participate in this, and it's a race. And so the money that's being put into this, and again, talked about fiscal earlier a little bit, interest rates, governments and companies are going to spend money on this. Companies are cash rich. Governments are spending. The G7 just came out with their outlook, or the IMF, for fiscal for the next through 2029. No change. So there's no community for significant fiscal cutting, and you have the companies also spending. So there's, and again, NVIDIA is a perfect example. It increased its CapEx, it raised its dividend, it's got a stock split. So there's all these things that are happening because they're making so much money. They made $15 billion in a quarter.
Well, you had Greenspan, for example, back in the 90s, early aughts, talking about the productivity boost, the paradigm shift, basically from the internet age. Do central bankers this time around, are they aware of the potential changes to the macro landscape that you're talking about, and they need to start thinking about policy potentially differently because of that?
Yeah, that's an excellent question. I mean, we're believers in what we call the global macro blue sky outlook. So 2023 to 2027, we see a very bullish outcome. And this, what we just talked about, underpins that, because we wrote a piece a couple weeks ago called The Age of Investment. We are in an age of investment. So 2010 to 2020 was monetary policy driven. Central bankers ruled the world. Now we're in the space where fiscal policymakers are going to rule the world. And again, it's a recognition that we need sovereign AI. We need to pay for it. We need climate mitigation. We need to pay for it. We need defense spending. We need to pay for it. And so all these things are driving, as I say, we believe an age of investment, which is going to reinforce that productivity gain, which is also being fueled by a fact that we're in a shrinkage of the global workforce, right? So demographically, we're in a whole new world, which we think is going to, again, continue to drive automation, drive robotics, and drive the regionalization of things so that you have a whole reshaping of the supply chain, which is happening in Asia right now with China. I mean, China is basically carving out Southeast Asia, which is the fastest growing part of the world, and they're going to dominate that space. And you just look at what they're doing with EVs in Thailand and Vietnam, et cetera. They're setting up a regional production supply chain for EVs, and they're going to own that space.
Well, I wanted to ask you about China because so much of your thesis, basically the basis is that China is still integrated with the West. What happens if it's not?
I don't believe that that's going to happen.
But do people actually think we would see what we saw with Russia's invasion of Ukraine within a weekend? You had companies pulling out, their central bank assets locked.
Yeah. Well, I think we've made it clear to China that we want to control their ability to rise on the tech stack. And so they're now coming back to us and saying, fine. And I think that's an opportunity, right? What we call our two tech stack thesis, right? Where the Chinese companies are going to dominate China tech stack. The American companies are going to dominate the American tech stack. That's fine. Investors have cottoned on to the latter. They haven't figured out about the former, right? So you have China tech selling at a massive discount to U.S. tech, even though the China tech space is twice as large, growing twice as fast. And so for us, we want to own the China tech space because that's where the opportunity is. And now you're seeing the same thing with EVs, right? China does not want to, China is integrated into the global trade patterns, right? They have massive trade surplus, they have massive exports. They cannot afford to be cut out of the global trade flows. And so you're seeing that in the reaction, we believe, to Biden's announcement last week about 100% tariffs on EVs. That's huge. But yet there's been nothing from the Chinese because they know they need to keep the Europeans on side.
Well, they signaled they're going to potentially have tariffs.
And they want to do it on the European side. They need to keep the Europeans on side. The Americans, it's kind of already a done deal. So they're threatening the Europeans with big tariffs on internal combustion engine European exports into China. And that's a massive market for the Europeans. And that's where the game is being played. But I believe China will continue in the economy, but the tech stack is being divided up and being closed off on both sides.
Jay Pulaski of TPW Advisory, Tripolar World Advisory, is sticking with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hakis. Yahira.
Hi, Lisa. The rally in global equities is at risk of overheating, according to Bank of America's Michael Hartnett. The bank's so-called global breath rule shows that about 71% of equity indexes are trading above both their 50 and 200-day moving averages. Hartnett says if that number goes above 88%, it would trigger a sell signal. A leading candidate has emerged to take the reins at the FDIC. White House officials have held talks with Kristen Johnson, the Democratic commissioner at the CFTC, according to a person familiar. The Biden administration is aiming to quickly fill the role after former chair Martin Gruenberg said he would step down on Monday following complaints of a toxic work environment. And Tesla is hiring. The EV maker posted more than a dozen autopilot and AI jobs in the first sign of workforce growth after weeks of rolling layoffs. The company's career site has been largely empty amid the job cuts, which are expected to impact at least 10% of the company and last through June. That's your Bloomberg Brief. Lisa.
Yahira, thank you so much. Up next, President Biden defending Benjamin Netanyahu.
We made our position clear on the ICC. We don't think there's an equivalence between what Israel did and what Hamas did.
That's coming up next. You're watching Bloomberg.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Ending the week before a long weekend with a bit of relief, a bit of gains after yesterday's massive 0.75% sell-off that was the biggest in about 3 weeks. S&P futures up about 0.3%. You could see a little bit of dollar softness, a little bit more optimism about European growth, as well as more pessimism about just how much they can cut this year when I'm talking about ECB rate cuts. 10-year yields, a little bit of a bid into it, a little softness in the commodity space. Under surveillance this morning, President Biden defending Benjamin Netanyahu.
On the ICC. We don't recognize the jurisdiction, the ICC, the way it's being exercised, and it's that simple. We don't think there's an equivalence between what Israel did and what Hamas did.
Here's the latest. Israel pressing on with military operations in Rafah, announcing that 1 million civilians have been moved from the city, even as the International Criminal Court seeks an arrest warrant for Prime Minister Benjamin Netanyahu on war crime charges. Aaron David Miller of the Carnegie Endowment for International Peace joins us now. Aaron, I gotta say, I don't have any clarity on how this is going to end. I don't think anyone does. Can you just give us a sense of the state of play of what's still on the table? Are we still talking about potentially ceasefire discussions?
Yeah, thanks for having me, Lisa. 9 months into this war, we're in a strategic cul-de-sac, and I don't see a clear, discernible way out. If there's any good news, and good news with respect to the Israel-Hamas war is always obviously relative, is that we've avoided a major regional escalation. That is to say, a major confrontation between Israel and Iran, or a war that would involve the United States. That seems to be something that can be managed. On the Israel-Hamas front, however, I think we're stuck. CIA Director Bill Burns is on his way to Europe in coming days to meet with the Mossad head, David Barnea, and the Qataris to determine whether or not there is any possibility of negotiating a ceasefire. But even here, Middle East negotiations always have two speeds, slow and slower. And Benjamin Netanyahu's objectives and Yahya Sinwar, the principal Hamas decision maker, ensconced in some tunnel somewhere below Rafah, Khan Yunis, neither of them see much urgency in bringing this to an end. So I think right now, again, it's likely to be a hot summer. And it seems to me that the pictures in Gaza are creating and will continue to create huge problems, humanitarian suffering, but also on the political side with respect to the administration as it faces a very consequential election in November.
The U.S. military spokesman said that Israel is operating with care and precision. So are they carrying out this Rafah incursion the way that the U.S. is okay with?
Well, what they're not doing is dropping 2,500-pound bombs. That's the munitions shipment that the administration, one munitions shipment that the administration chose to pause and or delay. The administration has created a red line, and when it comes to the U.S.-Israeli relationship, that red line often turns pink. I think the administration, frankly, is giving the Israelis the benefit of the doubt here. They're not launching a massive ground campaign. They're not carpeting the areas as they did in northern Gaza from the air. It's more limited, it's more precise, and over 1 million people have moved, but they've moved to areas, at least Al-Mawasi, Khan Yunis, where there is no portable water, there's no access to food, medical care, sanitation. So the international aid workers are obviously going to come to a much different conclusion. But right now, the administration, I think, has made a decision that the Israelis are going to do Rafah. They hope it's done relatively quickly, so that they can begin to get to the issue of what comes next.
You mentioned the ceasefire negotiations. I'm just seeing a headline from earlier this morning from the New York Times that Israeli forces recovered bodies of 3 more hostages in northern Gaza. It's devastating. We don't even know what the death count might be on these individuals. Where does all of this leave the hostage negotiations? Not just ceasefire, but actually getting those hostages out.
This is the real problem. Yahya Sinwar believes he can survive this. And the way he's going to do it is to trade time, tunnels, and hostages for what he really wants, which is a comprehensive end to this struggle and the emergence of Hamas, perhaps not in exactly the same shape as it was pre-October 7, but still influential, and with the senior leadership still alive after this war ends. And that's going to mean that he will not release, even if you agreed to a limited deal to exchange the women, the elderly, and the infirm for a large number of Palestinian prisoners. That will leave him still with 50 males, both civilian and military. He's going to hold those people until he gets what he wants, and hopes that pressure from the international community, the ICJ, the ICC, the Biden administration, will continue to press the Israelis to be more responsive. So again, I'll say it again, we're in for a long, hot summer.
Aaron David Miller of the Carnegie Endowment for International Peace, thank you so much. Hopefully you can join us again soon, especially as we see the international response increase with yesterday Ireland, Spain, and Norway announcing they would recognize a Palestinian state. Jay Pulaski is back with us. And Jay, with your tripolar world theme, you have an interesting take on geopolitics. You wrote this: those focusing on geopolitics as a worry for risk assets have got it backwards. Geopolitics is actually a boon for those that view the world in a tripolar thematic fashion and are thus exposed to the 3 regions and to the themes that create across and among them. Explain.
Well, I think it's just fascinating time, right? Because you listen to that and you see the pictures, you read the headlines, and you think, okay, volatility must be like off the charts, right? The reality is the exact opposite, right? The VIX stock volatility at 1-year low. The MOVE, the U.S. Treasury volatility index at a 1-year low. Crude oil, right? I mean, we're in the Middle East. Crude oil must be like over $100, right? Because we're in this crisis. Crude is down 10% over the last 3 months. So clearly, the idea, if you're investing on the headlines, geopolitical headlines, you're getting it wrong. And so, you know, we're in the business of trying to get it right. And we're of the view that what is happening is really accelerating the process of regional deepening and regional integration in Europe. Europe has to scale up to build its defense. It has to scale up to create AI. In Asia, through China. China has to scale up Asian regional integration because it is being kept from expanding globally, particularly in the U.S., particularly in tech and in clean energy, right? The tech and the clean energy spaces are driving regional integration because they are no longer kind of global goods, right? The tech stack is being divided, and so you have to develop it internally. That helps develop the region. The EVs, President Biden just slapped a 100% tariff on Chinese EVs, even though they don't import, we don't import any, but nonetheless 100% tariff. So they are creating an EV supply chain within Southeast Asia. That is integrating Southeast Asia and China. And then here in the Americas, we're still stumbling over how do we integrate outside of Mexico. We've done a pretty good job with Canada, Mexico, and the U.S. through the NAFTA version, but we haven't done much at all with South America, and that's really an opportunity. So we see things like EV tariffs. We see things like China not being able to access cutting-edge semiconductor chips as creating the framework for deeper regional integration.
Jay Pulaski is sticking with us. Coming up, the summer travel season kicking off this weekend. Helene Becker, airline analyst at TD Cowen, joins next on what you can expect when you go to the airport and try to wait in line with the other 5 million people who are doing the same. You're watching Bloomberg Surveillance.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Closing out the week with a little bit of gains after otherwise a pretty stellar month, especially with artificial intelligence. Right now, what we're seeing in markets is U.S. equity is clawing back toward all-time highs with nearly a 0.3% gain on the S&P. NASDAQ about the same. Russell 2000, and this is interesting, gaining about 0.6% as people maybe recalibrate just how much the Fed really is going to cut rates and what that means for some of the most leveraged companies. When you work it through the bond market, you can see a bit of a bid into bonds, not a lot of drama, but a sense of reprieve after what we saw over yesterday's session, where you got hotter than expected, Danny, data on business activity in the U.S. plus inflationary pressures.
Yes, and it is so remarkable that the market cared more about that than NVIDIA, because who amongst us this week didn't say that NVIDIA was the big data point? Let's be honest, we all said it. But I can't help but wonder if some of the shift is because we just got this whole spate of Fed speak and Fed minutes that have not hawkishness, but a more hawkish tilt, talking about needing more data points from Waller before he can confirm that inflation is under control and can cut, from Bostic saying we are going to be higher for longer. Dare I say even some disagreement, Lisa, with Powell that potentially the bias isn't to cut. And I wonder if that made us more sensitive to the data.
Say it ain't so. We are seeing this work through, although again, not a lot of drama, not a lot of conviction. We did see a 20-year auction go off this week, and it went off without much of a hitch, a little bit of a tail. What you could see in the currency space is a bit of euro strength, and this to me, Emery, is really interesting because everyone's basically baked in a June rate cut. So we're not even talking about the sort of discussion around that, the uncertainty there. It's how many cuts they can do. And yesterday we talked about this earlier, but I think it's worth sitting on. We talk about the U.S. is exceptional in both the inflation and strength, but wage negotiations in Europe are yielding some bigger pay raises than people had expected.
And this is what people are concerned about, an uptick in inflation. Yes, June on the table. To your point, Lisa, what comes after that? Isabel Schnabel, you mentioned her earlier, part of the ECB. This morning she said she would caution against moving too fast on rates, which is that a question is potentially for the ECB, is it going to be one of these nip tucks in terms of a rate cut, or is it going to be a cycle?
And that's the reason why, under surveillance this morning, investors are pushing back rate cut bets to December following strong U.S. business data. Atlanta Fed President Raphael Bostic reiterating the message we've heard all week from Fed officials that the central bank needs to be patient. Jay Pulaski is still here with us. And Jay, just a beat from you on why you dismiss the idea of fewer rate cuts and potentially even the prospect of a rate hike as being damaging to the bullish thesis.
Yeah, we don't really pay a lot of attention to the Fed. I mean, I know it creates a lot of headlines and a lot of news, which we don't care about the news. We care about the reaction to the news. Sorry.
Carry on.
But
you're doing great.
Yeah, and so for us, it's a situation where we're focused on earnings, right? Earnings drive stocks, and the reality is that earnings are coming in better than expected because we have a strong economy. And as long as that's going to continue, stocks are going to be fine. And so when you look at Q1 results, earnings estimates going forward, the next 12 months have been raised to an all-time high. And so clearly the market believes companies are going to be able to continue to make money. And as long as that happens, we're going to be fine. Now, we don't have tremendous upside because we're pretty fully priced, right? So upside is earnings growth plus multiple expansion. We've had the multiple expansion. Now we're dealing with earnings growth. But what we're focused right now is on convergence and on the growth convergence. You just mentioned U.S. exceptionalism. We think that's ending. And so what we noted yesterday, not the U.S. PMIs, but the fact that the European PMIs were higher than the U.S. for the first time in a year. This is convergence. Europe is converging. U.S. up here, Europe down here, Europe's coming up, U.S. coming down, convergence. The opportunity is in the rest of the world, not in the United States.
People who work in the office and people who work at home are converging into working from the office. Citi and Barclays and HSBC are ordering more staff to return to the office 5 days a week. As FINRA industry gets set to reinstate pre-pandemic rules for monitoring workplaces that might be doing some heavy lifting, the changes will affect hundreds of employees at Citigroup and HSBC, with the changes at Barclays set to impact thousands of staff. Anne-Marie, our resident Get Back to Work correspondent, I gotta say, we have to clarify, it's not get back to work, it's get back to the office. I do wonder how much some of these executives at banks are thinking, it is so convenient that FINRA really tightened the grip here so that we can order everyone back to the office, which is what we've been wanting to do anyway.
Yes, of course, because they don't want mass mutiny before the summer. Bank of America, JP Morgan, Goldman Sachs pretty much already have this policy, meaning we want you back in the office 5 days a week. I only worked from home a few times during COVID, and it was because I was ill or was exposed.
Here we go.
So it's 2024. I don't understand why there is even this discussion of a policy.
But I can't help but wonder, okay, I think it is a very convenient excuse, to your point, Lisa, that FINRA is changing these rules. But if you look at someone like Barclays, who's the most strict, Barclays is trying to cut a lot of costs right now. They want to cut £2 billion. What better way than to ask employees to get back into the office and have some potential employees say, you know what, I can't do that. I'd rather leave than continue to work here in the office. We see surveys that say that employees don't want to go in, so yeah, that's pretty convenient too.
So nutrition methodology. Jay, are you a back to the office kind of guy?
Oh yeah, I love the office. I love the office. I mean, during COVID, I was in the office every day. And
the hum of the computer.
Yeah, exactly.
The fluorescent lights.
You know,
what gets
it's
better?
good for married life, right? I mean, let's face it. At least for me.
All right, let's save you here. The summer travel season kicking off this weekend with airlines balancing resilient consumer demand with ongoing fleet challenges. A Bloomberg analysis finding U.S. airlines are adding seats at the slowest pace since the pandemic. This should make for a really enjoyable experience. Helene Becker of TD Cowen expecting another strong summer travel season, adding, quote, we think we will see continued strong international travel along with higher fares. Helene joins us now. So Helene, how miserable is it going to be over Memorial Day weekend?
We're expecting quite a lot.
I think that we're losing your sound, Helene. Let's just reestablish that. Helene Becker there of TD Cowen, and then we'll come back to you. But both of you are going to be traveling in the airports. Why do you try to brave the crowds? What's your hack to try to get around them? Do either of you have, Danny?
No, I guess I'm just a, masochist, sadist, whichever one it is. I guess, I just love pain and suffering, because clearly that's going to be the case trying to brave the airports.
I didn't actually think about it until yesterday when John texted me. He said, by the way, I know you are going to travel Memorial Day weekend. Give yourself enough time to get to the airport. It took him almost 2 hours to get out of Manhattan to JFK. And then I woke up this morning and I read Helene's note and I said, oh, wow, 2.5 to 2.7 million people will be traveling today, Friday. And I thought, oh, this is maybe not the best decision I made.
Well, it's also because of all of the upgrades to the airports. They're tearing up all of the roads. It's going to take you even longer. Helene Becker of TD Cowen, I think that we've got you back. Helene, can you give us a sense of just what this is going to mean, given the capacity is coming down, prices are going up, more people are there, and then you have, of course, Clear, which I have an issue with, basically ushering people in. I mean, how busy is it going to be?
Yeah, I think you have to give yourself extra time when you're going to the airport because the lines are going to be long. We're at record levels. The 2.7-ish million that we're talking about, there will be days this summer when we see travel as much as 3 million people a day. And the system is having a hard time already handling the 2.6, 2.7 we get regularly, let alone adding another 300,000. So I think you have to bring patience. And I say this every summer because of thunderstorms and because you never really know when they're going to pop up. If you can take the earliest flight of the day, that is your best bet.
Elaine Becker of TD Cowen, thank you so much for being with us. We'll let you get off to your long weekend right now. Jay, how much do you think that the travel boom can really continue? I mean, you're talking about AI, you're talking about a tripolar world. How much are you talking about Carnival Cruise Lines?
Not enough, probably. We were invested in jets as a kind of reopening play, with jets as the ETF for the airlines. And it really didn't work, which is kind of interesting, because there has been a boom in travel, but the ETF for the airlines has not really done very well. So it's not an area where we've done much.
I wonder if we can kind of think about the consumer in this way too, because we've talked about the consumer continuing to spend, even though they don't have savings, prices are up, they're still spending. Not only are they still spending with prices up, but Jay, they are spending with the chaoticness that is going to be this travel season. The fact that there are no seats on planes, that traffic's horrible, people are even still willing to spend like that. What does that tell you about the state of the consumer right now?
Yeah, I mean, we're bullish on the consumer, right? I mean, we're at record low unemployment levels here in the U.S. and in Europe. There are fewer and fewer workers. Workers are getting paid more. When you're getting paid more, you consume, and people still want to, start the summer off on Memorial Day weekend, going to the beach or traveling or doing whatever they're going to do for the long weekend. I am happy to say I'm not traveling anywhere. I wish you all well making that trip. I'm going to be in the office, exactly. Lisa knows me too well. We've been around together too many years. So I'm just going to be sitting at home and trying to relax in the city. But look, we're bullish on the consumer globally.
Yeah.
We think there's a fully employed workforce, wage gains, and we're not believers that the consumer is going to create a problem, either here, Europe, or elsewhere in Asia.
Well, first of all, Jay, let me say I'm incredibly jealous of your weekend. I wish I had made that decision as well. I'm currently regretting it. But we were talking about this during one of the breaks, the confusingness of the data, because it is this K-shaped economy, because you have this huge bifurcation. So what do you use to get a sense of the consumer when maybe the headline data isn't telling you everything?
No, I think that's a great question, and we look at many different things, right, through our work, and talk to a lot of different people, and essentially we want to have a framework, right, and our framework is the tripolar world, and we have a view as to how that's materializing, and we put out in our 2024 outlook 4 macro surprises, right? Lower inflation sooner than expected. That's happened everywhere but in the U.S. Rising productivity, also in place. A return to stability, which we see with the volatility indices descending, and then early cycle. We believe we are in an early cycle global economic recovery. Most people talk about us being late cycle going into recession. That's been the thesis for the last 18 months. People still have it, even though it's been wrong for 18 months. So our feeling is that we're early cycle. We're in the beginning of a manufacturing pickup. We're in the beginning of a CapEx boom to build out all the things we spent time talking about earlier this morning. And that, for us, leaves us constructive. So we don't sweat the details. We're not sweating the Fed cutting, June, September, whenever. We're not sweating those issues. We're focused on the fact that earnings are solid, and that gives us the comfort to continue to stay fully invested.
Are you sweating what the CEOs are saying on earnings calls? Target, Walmart, Starbucks, they are seeing a more discerning consumer. Consumers who are saying inflation is biting. Walmart, I'm going to trade down.
No, actually, we're not, because we're not invested in that part of the marketplace, right? I mean,
but
we have the
opportunity. Say about the consumer, though. You don't see any cracks in this consumer?
No, I mean, we look at things like household net worth at all-time highs. We look at household net worth in liabilities versus disposable income, things like that. They're all very, very benign. There's nothing that suggests we're in any kind of approaching a cliff for the consumer. And so, to us, we're focused on the pick and shovels in the tech space. The miners, we're very bullish commodities. We're double-weighted commodities. We're completely underweight fixed income. We have zero treasury exposure. We've had zero treasury exposure for going on a couple of years now. And we're overweight equities, and we're triple-weighted right now in emerging markets. So triple-weighted versus our benchmark. We're very big believers in China tech. We're believers in Poland for European integration, Vietnam for Asian integration, Mexico for the Americas integration, and we're in copper miners, uranium miners, gold miners, natural gas, and these things have been working. And we think there's a real imbalance between how fast we want to build out data centers and how fast we can build a copper mine. And so what pulls those two things together is price. And so we're in the Jeff Curry camp, right? Copper is, like he just said, and he's a very respected guy, the best trade he's seen in his entire career. That resonates with us.
Jay Pulaski of TPW Advisory, thank you. I'll get you together with Dan Ives, and it'll just be an explosion of bullishness. It'll be fantastic. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. Treasury Secretary Janet Yellen acknowledging that persistent inflation remains a problem for many Americans. Speaking at the G7 finance meeting in Italy, Yellen said that wage increases in the U.S. are not keeping up with the high costs of food, rent, and mortgages. The comments come as polls continue showing Biden struggling to win over new voters. Yellen is set to meet with ECB President Christine Lagarde later today. Alphabet and Meta are offering millions to Hollywood studios to partner on AI. Bloomberg is reporting the companies have held discussions with the studios to license content for the tech giant's AI video generation software. This is a technology that can create realistic scenes from a text prompt. Disney and Netflix have declined to partner with the companies, while Warner Brothers Discovery is still weighing a decision. And NVIDIA CEO Jensen Huang had a good day yesterday. His net worth grew by almost $8 billion to $91 billion as shares of NVIDIA rose 9% following better than expected quarterly results. A majority of Huang's net worth comes from his stake in NVIDIA, the company he co-founded back in 1993. According to the Bloomberg Billionaires Index, Huang is now the 17th richest person in the world. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira. I love this idea, and I think, Danny, you nailed it, which is what do people do with that kind of money? They're not going to go just, buy a lot of apartments. I mean, they're going to basically funnel it back into stocks.
And that's why this time is different in this market, that even if we get some hiccups in this global economy, even if inflation continues to be a problem, assets can do well because they are bid up by the Jensen Huangs of the world that have literally nowhere else to put their money.
Because the rich gonna rich, and this is the reason why the banking industry is definitely shifting around a bit too. Up next, the case for higher for longer.
We need to rebalance the U.S. policy mix over time. Our call remains, as it has been for quite a while, first cut in December.
Next, you're watching Bloomberg.
Names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide create index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the
Welcome back. This is Bloomberg Surveillance, closing out the week with some gains. We see about the S&P 500 up close to those all-time highs once again, up about 0.25%, 52.99 near that 5,300 around mark. Meanwhile, a little bit of a bid in Treasuries fades. It is now a little bit of a sell-off. It's basically no action whatsoever on the day before Memorial Day weekend. Under surveillance this morning, the case for higher for longer.
Basically, the case is we need to rebalance the U.S. policy mix over time, and that means monetary policy less restrictive than it's now. We don't need to do it now, but we probably will have to do it in the coming years. Our call remains, as it has been for quite a while, first cut in December.
Here's the latest. Treasury yields jumping yesterday after strong U.S. business data prompted traders to push back Fed rate cuts. Terry Wiseman of Macquarie writing, the fixed income market already believes that R-star is higher than the Fed's current estimate. But should the Fed signal in June that its estimates of R-star are moving higher, it could be effective monetary policy signaling that takes the stock market lower. It could take longer-term U.S. Treasury yields higher, too, perhaps back to 4.75%. Terry joins us now. Terry, we were talking earlier with Lee Farage of State Street. He was talking about the idea of a potential rate hike back on the table the longer that inflation just seems like a hard beast to kill. Do you agree with that?
Well, in probabilistic terms, no, which is to say that I don't think we're going to get a rate hike. I would assign a lot less than 50% chance to seeing that happen between now and, say, the end of the year. Is it possible, though? Yes, anything is possible. And if you read the minutes carefully that came out for the May 1 meeting of the FOMC, you did clearly detect in the transcript that there were some members of the senior Fed's policy officials that would contemplate or consider raising rates again. But they also said that it would have to be under the right conditions. And I think those right conditions mean that we would have to see inflation accelerate from here. I don't think that's going to happen. I don't think the Fed thinks that's going to happen. There's a basis for believing that the next few months may see somewhat softer inflation in the U.S.
Okay. To me, the interesting point about your theory is that you were focused on the long end of the yield curve. And a lot of people have been saying that the Fed's been keeping rates high, yes, on a relative basis, but they've actually been somewhat stimulative when it comes to longer dated treasuries in terms of some of its repo lines and some of its other balance sheet policies, particularly after what happened last March. Why do you think that that's going to end? Why do you think that the long end could suddenly see something that it really hasn't seen for a sustained level so far in this cycle?
Well, it's going to require a different signal from the Fed, especially in respect, not so much of the long-term yield, but in the long-term outlook for short-term yields. And there's a little bit of a difference there.
Happy Friday.
Yeah, of course, without getting too technical, what the Fed may be trying to tell us, or certainly the hawks at the Fed are trying to tell us, is that do not expect that short-term rates will find an equilibrium in the twos again. In other words, 2 point something. There's probably still a large part of the marketplace that believes that eventually we're going to get back down to a 2% policy rate, but the hawks don't believe that. And I believe at least the hawks have a sound basis for that belief, which is that there are, in the long term, structural trends and tendencies in the U.S. and global economy that are inflationary. And therefore, that last mile of getting from 3% inflation to 2% will be tough, but it will only be made even tougher if you reduce rates, let's say, below 3% ultimately. And I think that's the thesis. And eventually, when the market recognizes this is the way the Fed is thinking, and it's not just a minority, but potentially a majority, the long-term yield will rise to reflect that.
Terry, what you're saying reminds me also that we came into this year with many people not just saying it was the year of the bond, but also that it was the year for curve steepeners, that this was going to be the time that finally we got out of a negative yield curve. It didn't happen because you have a front end that's scared of the Fed, and then you have a long-term end reflecting what you're saying and also scared of the economy. So if what you're saying is correct, are you loading up on steepeners again?
Yes. Look, the normal, typical shape of the yield curve should be upwardly sloping, okay? There are many distortions that one can point to, some, maybe dating back to COVID, others dating back to the uncertainty with regard to Fed policy that are making that curve inverted right now. But when if you believe that the normal shape is upward sloping, you should consider that right now you would not want to be invested in the long bond. There is an implicit handicap there if you're buying the bond at 4.4, 4.5%, when short-term yields are high, likely to stay high, and then when you consider all of those long-term structural drivers of inflation in the economy.
Well, Michael Hartnett over Bank of America, in his note this morning, said essentially that U.S. Treasuries are 48% of the global government bond market. U.S. credit and stocks are more than 64% of their global markets. And so says that policymakers know that the U.S. is too big to fail, so they are setting policy knowing that recession is more consequential than inflation. What do you think of that?
Well, that may be the case, but the policy that we're talking about here is policy mainly that impacts the short-term rate. The long-term rate is determined by the market. The short-term rate is managed by the Fed, effectively, and other central banks. So although it's nice to believe that policymakers have a say directly over the long-term yield, in fact, they do not. That is determined by the actions of traders and economists and analysts and like myself, with very little reference most of the time to what the Fed is doing on the short term of the curve, the short part of the curve.
I'd love to get your take on the consumer. We just heard from Jay Pulaski, who says he's not listening to the earnings calls when Walmart CEOs, Starbucks, Target talk about the fact that consumers are becoming more judicious in what they decide to buy. Are you seeing cracks on the consumer side?
Not really, certainly not yet. I would argue that the consumer is one of those structural tendencies or trends, longer term in the economy, that is inflationary, but not necessarily for cyclical reasons, not necessarily because the Fed is keeping interest rates lower than it should be. The reason is demographics. We have a baby boomer, a cohort that has been made fantastically rich by the stock market over the last few decades. And now they are retiring, and they are no longer working, which means they're no longer producing, but they still want to consume. Right? And that is inflationary. It adds to the imbalance between supply and demand in the economy in the direction of too much aggregate demand and too little aggregate supply. And that's going to continue to roll on for the next few years. Eventually, it'll reach me, and I'll be consuming more than I'm making. So yeah, that's what's happening, and that's a structural theme that one has to consider when one is looking at things like the long-term bond yield.
Terry Wiseman of Macquarie, thank you so much. Have a wonderful long weekend.
Thank you.
I hope you enjoy it. Coming up, we've got Colin Graham of Robeco. We've got Patrick DeHaan of Gas Buddy on just how expensive it's going to be going forward to drive around. Kathy Bostancic of Nationwide and Alberto Gallo of Andromeda. Honestly, to me, one of the big takeaways has been just the confusion, Anne-Marie, in classifying whether the consumer matters, how much they've been weakening, and really, are their savings finally up? Is their credit quality deteriorating? What's going on?
Well, I think you go back to what Mohamed El-Arian said. You have to listen to the earnings calls and what CEOs are saying about inflationary pressures. And in that sense, I think it was one of our guests this week, Drew, talked about latte shock. That's what the consumer is feeling.
Really? It's all about the lattes? That really resonated with you.
Well, because they are expensive.
Only the lavender ones.
Well, honestly, do you like lavender lattes?
No, that's not for drinking.
I can't really.
It's for smelling.
All right, well, we have not that conversation coming up next. We've got some economic data as well. Right now, in the markets, you can see a little bit of a lift following yesterday's massive sell-off. It was not massive, but it was the biggest one in 3 weeks. Up now, session highs 53.02. This is Bloomberg.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
As an asset allocator, I don't think I've ever been so interested in stocks.
Corporate health looks very good right now. We do feel very good about that.
The momentum continues to get even stronger than it had been earlier this year.
Everybody is trying to get into the AI world. The question will really be who ends up using it better.
Get the popcorn out, because this AI revolution in 1995 moment, it's just starting.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
30 minutes until economic data, 90 minutes until the start of trading. We've got 120 minutes until the University of Michigan survey, and we've got 340 minutes until the close of the bond market. Welcome back. This is Bloomberg Surveillance on the day before a long weekend. Anne-Marie Hordern is here. Danny Berger is putting up with us. You've already 2 hours in. Thank you so much for doing this with us. And John Ferro is on a well-deserved break. To me, very much front and focus is this question of how much are we seeing inflation remain sticky? And frankly, Danny, how much does that challenge the thesis that stocks can keep riding through it?
If you are of the opinion that all that matters is that there's economic growth and that's why inflation is higher, then it doesn't matter and stocks can keep rising through it. That was Jay Pawlowski's view. But Lisa, I think it was interesting because in that he basically said, okay, but our upside is limited because you have rallied so much. We, to a large extent, have already priced in the good earnings. So how much better does it need to get to actually be able to say that the inflation doesn't matter?
Anne-Marie, who do you think is going to care more about the University of Michigan sentiment survey? Do you think it's going to be traders? Do you think it's going to be Joe Biden's campaign?
I think it has to be the Joe Biden campaign. You saw Janet Yellen speak about inflation just in the last 24 hours. She's in Sintra. She sat down with the Financial Times. She talked about, yes, we do know prices are going up. It's affecting people at the grocery store, their rents. If you're young, trying to get on the housing market, she says, yes, we take this into concern. And this is what continues to dog the Biden campaign in the polls. Number one issue is the economy. When you try to dig down, what's that issue about the economy that really bothers you? Student loans, cost of goods, housing market. It's cost of goods. It's inflation.
Which raises this issue. They feel bad, and we've continued to say this, but they keep spending, whether it's a lavender latte, whether it's whatever it is, maybe not as much there, but in other places to travel where you guys are going to be competing to get on the security line this weekend. But Danny, I do wonder, just whether we think about the Ian Shepherdson view of things, which is basically long and variable lags still are in play and are going to hit hard, or whether we go to the Jay Pawlowski view of the world, which is stop being ridiculous. It hasn't happened, so why are you considering to believe in something that seems like it's just not reality?
Honestly, those two views just underscored to me how confusing everything is right now, how confusing the data is, that very logical, smart people can look at the same exact set of data and come away with exactly bipolar views. But that's what we're seeing throughout this market, whether to your point, Anne-Marie, of trying to understand the consumer. The data does not make sense, and I can't help but wonder if this data is equipped for the modern world that we're living in, if the measures we use now can actually help us figure things out.
One aspect of the data does make sense, and that is near record highs on equities, and that's what you can see again this morning as people do bid in, given the sell-off yesterday. Maybe that was a buyable dip, 0.75% decline. Hey, at least it's something. 5,300 on the S&P ahead of the open in about 90 minutes time. A little bit of dollar weakness, euro strength, 108.43 as people look to this idea that maybe the ECB is not going to be able to cut rates as deeply as some people had expected, given all of the strength. 10-year yield just kind of wavering around that 448 level. In the crude space, kind of clawing back some of the earlier losses, now down just 0.1%. Coming up, Rebecca's Colin Graham as traders push back rate cut bets. Patrick DeHaan of Gas Buddy, as a record number of Americans plan a road trip this summer and are going to be checking out those billboards to see just how much it's going to be to fill up their tanks. Nationwide's Kathy Bostancic reacting to data and looking ahead to next week. We begin with the big issue. Traders pushing back expectations for the Fed first interest rate cut amid a pickup in inflation. Rebecca's Colin Graham saying this: many U.S. consumers are immune to interest rates. The U.S. economy, driven by a resilient consumer, has been the most important source of growth in the global economy post-COVID. Colin joins us now. Colin, thank you so much for being with us. You know, Emery has been asking this question consistently for the past couple of weeks, and honestly, it's an important one. Why is it not that we're seeing cracks in the consumer when you take a look at some of the earnings that we've seen from the likes of Starbucks, from the likes of some of the from the retailers? Why are people so quick to dismiss that and say, it doesn't really represent something broader?
I think you've seen the U.S. consumer actually deleverage since the global financial crisis, and they have a propensity to spend. So any fiscal stimulus that comes out of the government gets spent. So therefore, it's not saved and it's spent. And I think you've hit that nail on the head here when you're looking at, going to Starbucks or Nike or whatever versus travel in terms of going away, doing the experiences, doing the services. And I think that is the sort of the dilemma or the split that people are really trying to understand here. And it's not surprising you've seen earnings a bit weaker here and there, but overall, the US consumer is in a job, its wage growth at the median running higher than inflation, so therefore they feel better, and so therefore they'll spend.
Colin, which side do you weigh in on? The Jay Pawlowski view of the world, which is everything is awesome and we're in an early stage of a recovery that's going to broaden out, or are you in the Lee Farage camp where suddenly we're talking about the prospect, maybe albeit small and a tail risk, of a rate hike, maybe even early next year in the face of strength that's going to torpedo certain valuations?
I think that whether it's one rate cut down or one rate hike up, I don't think it really makes that difference. We're not going from 0 to 5 again. We're not going from 5 to 10. So from that perspective, a little bit up, a little bit down here, I think is part of the just finessing the policy. I don't think it's really going to change anything. I do subscribe to parts of what Jay said earlier in terms of the emerging markets, the turning around in the manufacturing, the commodity side of things, but I sort of agree that valuations are too high at the moment. And so, with the liquidity injection we saw during May, you can see why equities have jumped so much and recovered from their April drawdowns.
Colin, if it is just more of a finessing, of a mid-cycle tweak, a cut here, a hike here, you wait a month, maybe you don't, then does the big deal we're making about Europe in terms of rate differentials, that if they go first and they continue to go, that it's going to be a problem for the euro, is that not the case this time if we are just talking about finessing?
Yeah, I think the path of ECB rate cuts could be difficult. You know, there might be one, possibly two, but once you start getting into 3, 4, you have to think there's something bad going on in the economy, and that's when the euro will be hit. And if the euro gets hit, then actually the imported inflation will actually start to push inflation numbers back up. So therefore, leaving the ECB with a dilemma there, and I think the ECB is in a more difficult place than actually the Fed at this particular point.
So if they are in this dilemma at the moment, Colin, do we need to start talking about euro parity again, if that's where this is going?
I think if they say that they're going to cut rates and continue to cut rates, I think that will lead the euro to go lower. So we could start easily talking about parity, because I think that if you see big rate cuts, then there's something wrong with the economy. And therefore, then you start to see growth falling and possibly inflation, and therefore that will cause the currency to lose one of the supports, which we're seeing at the moment with the global manufacturing recovery and the recovery in Europe. You're actually seeing that quite clearly now. You saw the banks report very good earnings. So, you know, the European economy is actually doing okay, and therefore I can't see why they would want to do more than one rate cut, possibly two.
But you said earlier that the ECB is in a worse place than the Fed. So how then is the European economy doing better than you were expecting?
Well, this is from the manufacturing side. So the manufacturing sector has been in pretty much a recession for the last 18 months, and you're beginning to see that bottom out. You saw that in the US data yesterday with the manufacturing PMIs turning around as well. So Europe is very much an open economy and very much more a manufacturing economy than necessarily a service-led economy and a consumer-led economy. So they really need that growth in order to get you know, the German people to feel better about spending. So it really comes from the manufacturing side and the industrial production side.
So Colin, what's your biggest conviction, highest conviction bet right now?
I still think emerging markets over the next 12 months should outperform. You know, at the start of the year we talked about China, and that was my surprise for 2024, that Chinese equities were going to be the best performing equity market this year.
Colin Graham of Rebecca, thank you so much for being with us, and have a wonderful long weekend. Although, is it in London? Do they do Memorial Day? No. You both have lived there. No?
No, but they have enough bank holidays, so they're fine.
They don't, it's so sad, though, because you don't even get like a reason for it. It's not Memorial. It's like, hey, you just get the day off.
I actually think it is their May bank holiday this Monday, so
maybe
everyone gets a holiday.
You get a holiday, you get a holiday, you get a holiday. And you're very happy about it. Let's get on right now an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hawkins. Yahaira.
Hi, Lisa. Elon Musk's SpaceX has initiated discussions about selling existing shares in a deal that could value the company at $200 billion. That's according to people familiar with the matter. The valuation would be a premium to the $180 billion it fetched in its previous tender offer. SpaceX is already on par with some of the world's largest publicly traded companies by market cap. Vice President Kamala Harris is gaining popularity in key states. The latest Bloomberg Morning Consult poll says 48% of swing state voters say they trust Harris to step in for President Biden if he can no longer serve. This is the highest reading since the survey was first conducted back in October and comes after a series of high-profile events Harris has held around abortion. A new development in the Ozempic revolution, the New England Journal of Medicine said that patients with kidney disease caused by diabetes were 1/5 less likely to die of any cause during the study if they took Ozempic rather than a placebo. The findings add to evidence that Novo's treatment for diabetes and weight loss can help with a host of interrelated conditions around obesity. One nephrologist said that the findings will likely change the way kidney disease is treated. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. And it's definitely got a lot of insurance companies quaking in their boots, because basically they're going to have to pay for it if essentially it can solve all of these other problems. I got to say, Danny, what happened to this sort of obesity sort of pandemic over that people were talking about that all of these weight loss drugs were going to ignite massive gains akin to artificial intelligence. I mean, Novo Nordisk is only up 34% this year. That's nothing compared to NVIDIA.
It's true. 34%. I mean, it's still not nothing, Lisa. But I guess, you know, it's the supply-demand thing. There's a lot of demand for it, not lots of supply. Maybe if insurers approve it because of the kidney disease thing, maybe, you know, that solves some things.
That's definitely what people are looking into. That maybe you're going to end up with this idea that they're going to have to cover it if it basically solves everything.
Yeah, does insurance have to step in? The government might have to have a say on this as well if it comes down to things like Medicare, Medicaid. But if it's going to be used more than just weight loss, then insurance might have to pay.
We're all going to be on it one day, it sounds like, the way that this is going.
I don't think so.
You get a big shot. You get something. No, not necessarily. Up next, the summer travel stress test for consumers.
People still want to, you know, start the summer off on Memorial Day weekend, going to the beach or traveling or doing whatever they're going to do for the long weekend.
That's coming up next, and neither of you are needed in any capacity. You're watching Bloomberg Surveillance.
Was going to keep Rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
$5,300 back there. We're definitely climbing toward all-time highs once more. Welcome back. This is Bloomberg Surveillance on the day before a long weekend. I'm sure all of you are glued to your screens, just riveted and counting down the seconds until you can leave for your long weekend. S&P futures just off some of the session highs, up 0.25%. A little bit of dollar weakness across the board. Not a lot of drama. Everyone's just sort of hoping nothing really happens to really draw them back to the office. Under surveillance this morning, the reason why people are looking forward to the weekend, the summer travel season begins.
We're at record low unemployment levels here in the U.S. and in Europe. There are fewer and fewer workers. Workers are getting paid more. When you're getting paid more, you consume. And people still want to, you know, start the summer off on Memorial Day weekend, going to the beach or traveling or doing whatever they're going to do for the long weekend.
Here's the latest. It is the busiest weekend of the year for road travel. A survey from Gas Buddy saying 60% of Americans are planning a road trip over this Memorial Day weekend. Other people are going to be flying and they're going to be going to the airport. Patrick Jahan of Gas Buddy writing this: while Americans gripe about the cost of gasoline, it doesn't seem that too many are going to be deterred from hitting the road. Great news for those who are planning to travel. Motorists are likely to see more stations lowering prices to $2.99 per gallon or less as the summer wears on. Patrick joins us now. Patrick, riddle me this. What happened with all the people saying we didn't have enough refineries? Yes, we're pumping 13 million barrels a day, but there's supply cuts coming from elsewhere. Gas prices are going to skyrocket during the busiest driving season of the year. Why do you think that's not true?
Well, we've gotten a lot more breathing room here over the last 6 to 12 months or so. It hasn't been U.S. refining capacity, but there have been some global additions. I would point out, though, I think this year in kind of the post-COVID world, a lot of Americans hit the road in 2022. That's why gas prices did skyrocket over $5 a gallon. Things cooled off last summer. A lot of folks hit the road last summer, but I think this summer is also going to skew international air travel. TSA reporting records. Our gasoline demand data, I just looked at it, did shoot up for yesterday, about an 11.7% rise from Thursday prior. So we are starting to see Americans fill their tanks. But I don't think gasoline demand is going to be at record levels, though a lot of folks are going to be hitting the road or traveling. They may be doing so via air. Of course, the EV transition is part of that discussion as well, although that has slowed down. No matter, a lot of Americans hitting the road this Memorial Day.
So, Patrick, let's just sit on that for a second, because some people do say this is the sort of understated aspect of demand in the gasoline market, that more people have more efficient vehicles, even if it's not electric vehicles. It could be hybrids. It could be just cars that get better mileage for their gas. How much is that a factor of demand for the gasoline?
Well, probably a notable one. You talk about the EV transition where people completely ditch gasoline. That's probably a small but rising part of the conversation, especially in areas like California that are looking and pushing incentives for Americans to move into those vehicles. But as you mentioned, look at manufacturers, how they've skewed to plug-in hybrid electric vehicles or mild hybrids. A lot of that. I mean, $5 gasoline. Americans, when they buy a new vehicle, often have the memory of those gas prices. And, a vehicle, buying one is a long commitment. And so a lot of Americans have been looking at some of those more fuel-efficient options in the last couple of years. Keep in mind, too, that like myself at this moment, work from home is still a thing. A lot of Americans still doing that. And that's probably where some of this drop in consumption is coming from, the fact that it's been a very slow return to the office.
If we start inching towards $5 a gallon, what do you expect the White House to do? You know how important gasoline is to them. You have been a guest at the White House when Ron Klain was chief of staff, and they were obsessed with this when prices were spiking. What do you expect the administration to do?
Well, they don't have a whole lot of levers. I know that every American thinks that the White House has some sort of huge lever in the White House, the Oval Office, that controls prices, but there's not a whole lot. I mean, the president can offer things like unleaded 88 or E15 all summer. That's what he's done, right? That's going to be available through waivers via the EPA. But the only other thing really is just to kind of hope and pray that hurricane season isn't going to be as bad as they expect. Now, again, some of the issues with summer gasoline prices come from the fact that the U.S. is very fragmented when it comes to these summer blends that everyone's heard of. To give you one example, refineries have been struggling here in the Chicagoland area. Chicago uses reformulated gasoline, which is different than downstate Illinois, which is different than Detroit. So there's all these different localized blends. If the federal government wanted to do something, they could really simplify the system. I mean, California and Arizona both have their own different blends. It's like you get a blend, I get a blend. Everyone has different blends, and when refineries go down, that becomes problematic to supply all of these various blends. So aside from that, I mean, the White House already shutting down now the Northeast Strategic Gasoline Reserve. Of course, that was mandated by Congress. Trump tried to do it in 2020. But even that is not going to really move the needle. So the White House is just kind of along for the ride here, hoping that OPEC will continue the status quo and oil prices will continue to be under 80.
What do you think could be a bigger impact this summer? Natural disasters or geopolitics, given we have two hot wars, one in the Middle East and, of course, in Ukraine?
I think without a doubt, I think the weather is going to be a bigger factor. The Middle East, I mean, Iran now has a lot of its own issues with the helicopter and elections coming up. So Iran and Israel, I mean, that was something to watch, but even that didn't really move the needle. I think oil markets are kind of stuck in this depressive state, right? OPEC is now saber rattling. They're going to have a meeting virtually, and oil prices this morning still under $77 a barrel. So I think weather's the big wild card. Nobody controls it, right? Even the Middle East, there's some certainties, even if they're unreliable. Mother Nature's just completely question marks all over it. Will we get a major storm in the Gulf of Mexico? Is it going to be a Harvey and dump 1 to 2 feet of rain on refineries shutting them down. I think that's really the thing for this summer that keeps me awake. Will hurricane season turn into the dread like everyone's talking about? National Weather Service yesterday issuing its most active early forecast ever for hurricane season, and those sea surface temperatures are rising, and it's quite concerning.
I'll tell you another thing that's keeping people up at night, Patrick, who are on their way to travel. It is the headline after headline about Boeing and concerns about that plane. You couple that with what we're expecting in the airports. It's going to be extremely busy. It's going to be chaos. Do you see any of that translating into folks more wanting to travel via their car rather than going to the airport?
Well, we know Americans have an affinity for their cars, and keep in mind also the headlines over that Singapore Airlines turbulence is probably getting a lot of attention as well. But keep in mind, once you buy those tickets, especially with some of these fares now, you're stuck with it. Oftentimes airlines now have those restrictions back in place. But I think to your point, America still has a love obsession with the fact that cars are mobile. You can leave whenever you want. You don't have to do security. So yes, I think Americans, if anything, that haven't yet figured out their travel, they'll probably skew more to using their vehicle, especially as summer wears on. Gas prices we expect are going to be highest on Memorial Day, lower for July 4, and pending Mother Nature, even lower for Labor Day. So I think that's probably going to open the door for some of those last-minute road trips. As our survey points out, Memorial Day is the most traveled holiday, but if you look at July 4 and Labor Day, plenty of people are hitting the road. They just haven't planned it yet. And those folks that haven't planned ahead are probably going to gravitate towards gasoline consumption. So we could see a little bit of a rebound there, to your point.
Patrick, can you put some numbers on that in terms of what price you expect things to be just heading into Labor Day?
Again, a wide range of possibilities. We have the national average potentially as low as even $3.29, but as high as $3.90. August and September are the months that we have the least certainty out of all 12 months that we put our forecast together. August is really up in the air. Why? Because you get a lot of late summer demand. Will we get hurricane season that's more active before? If we don't get any hurricanes, we're probably going to skew to the lower part of that forecast range, maybe 330 to 350. But we've all seen the impact that something like a Hurricane Harvey can have on gasoline prices. And we could skew to the 380s and 390s, or like last year. You'll remember that a spat of refinery issues hit both the West Coast and the Plain States all at once and caused a late summer surge in the national average to $3.90 a gallon. So we're very mindful of what happened last year.
Patrick, we just have about a minute left. There is a theory that the president can just empty the Strategic Petroleum Reserve and drive prices down. Is that valid?
Well, I mean, that's what so many Americans forget about. We all stare at the price of oil, right? There's a lot of couch analysts who say oil is this, gasoline should be that, but we all forget about the middleman, the refinery, the thing what we've talked about. COVID still, remember, has reduced refining capacity. So you can have all the oil in the world. The SPR could be full. You could release the whole thing. That doesn't translate to usable products like gasoline, diesel, and jet fuel. It still is subject to that bottleneck of the refinery. So that's where the president is relatively powerless. This oil reserve is not going to necessarily equate to lower gasoline prices. And keep in mind, too, when it comes to that gasoline reserve, that thing costs $200 million to maintain over the 10 years it's been in existence. The cost of that gasoline, the street value today of that gasoline, $103 million. So it's probably a good thing we're shutting down that gasoline reserve. I would point out that's something that even President Trump tried to do back in 2020.
Patrick DeHaan of Gas Buddy, thank you so much. And this is really one of the key metrics that people are looking at to consumer spending, because essentially the higher prices go on gasoline, typically the less disposable income in a lot of families, and vice versa if prices go down. Coming up next, breaking durable goods data, Nationwide's Kathy Bostancic and Alberto Gallo of Andromeda Capital.
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
And we are still talking about work from home versus the office. Welcome back. This is Bloomberg Surveillance with a lift to equity markets to finish the week after yesterday's declines. We do see retracing some of the earlier gains, but still around that 5,300 round number. NASDAQ futures up 0.2%, just minutes away here from durable goods data. Why does it matter? Well, it's the latest read on maybe airplane orders, among other things, but also at a time of better than expected data more broadly in the manufacturing sector. Michael McKee of Bloomberg, our own economics and policy correspondent, here to break down the numbers.
Well, surprisingly better than expected, because Boeing had not done well in the prior month in terms of orders, but their orders don't always match up. So we get a 0.7 gain for durable goods orders in the month of April. That's the preliminary number, after a 0.9 gain the month before, and it had been revised significantly lower. Durables ex transportation up 0.4%, and capital goods ex aircraft ex defense orders up 0.3%. That's the one that matters to economists and the Fed, because that goes basically into GDP, up 0.3 after a negative 0.2% in the prior month. Shipments for capital goods during April up 0.4, which is going to be an addition to GDP for the second quarter. So we have good news there as well.
What's interesting to me is that you actually are seeing something of a reaction in bond markets, considering the fact that this isn't often that significant of a market-moving event. I know you're laughing, Mike, but I'm not wrong. If you take
I'm laughing because I think everybody is there. They had to come into the office before they head to the Hamptons, and so as long as we're here, we're going to trade on something.
Well, there we go. They're trading on it, and it means selling off treasuries. Two-year yields 4.95%. Not necessarily a huge dramatic move, but direction after being directionless. Basically, another better-than-expected print after yesterday's business activity data. Mike, can you just look at that data for a hot second and just give us a sense of why people were so surprised? Business activity accelerating at the fastest pace in 2 years, with goods prices really accelerating much beyond people's expectations.
Well, that's it. I mean, people are looking for direction, and they're trying to figure out where the Fed is going to go. And there's been all this talk of the economy slowing, and then you get these numbers that say the economy is going to be a little faster. And in the absence of anything else that's going to drive the bond market, people reacted to that. What was interesting is the reaction in the equity markets to what was happening in the bond markets, because the equity markets have largely ignored the economic data, whether it's going up or down. The equities have just been going up, and now all of a sudden they're taking a hint. Is this the start of a change in thinking about the economy and what profits will be going forward?
Well, to that point, stocks dropped like 5 points. Now they're back where they were before this data came out. So stocks this time around apparently don't care, Mike. But I wonder, when you look at that, you look at durable goods orders, you know, better than expected. When you look at the data yesterday, better than expected. You pair that with some of the weak survey data for small businesses and businesses in general. Does that make us say, maybe we need to discount that weaker data for surveys a bit more?
Well, it just makes it harder overall for the Federal Reserve and for people on bond trading desks to get a clear picture of where things are. The soft data has been soft, although the small business numbers went up a little bit last month. We'll see. We get Michigan sentiment today. We'll see if that changed at all. It is perhaps possible that gasoline prices falling, as your previous guest was talking about, and the weather turning nicer may have people in a bit better mood about the way things are going.
And buying airplanes, maybe. I will just say this. We are looking at some serious downward revisions to the prior month's data, which might be why you see, Danny, some of the tempering of the initial expectations of this just sort of feeding into some of the positive economic surprises. Just to give you a sense of the scope of these revisions, prior month was a 2.6% increase for durable goods orders. That was revised down to 0.8%. Mike, we've seen this. these numbers that come out, how reliable are they, given the fact that they're often revised quite considerably and revised downward?
Yeah, durable goods orders are not particularly useful because they are so volatile, and they're also driven so much normally by Boeing because airplanes cost so much money that a couple of orders still can skew everything. So you look at this and you look at the trend and you kind of wait till we get to the end of the quarter to try to put it all together.
Michael McKee, thank you so much for being with us. Stay close. We're going to be speaking with you, I'm sure, throughout the morning, also with University of Michigan Sentiment Survey coming out at 10 a.m. Eastern, including those key inflation expectations. We can talk also about methodologies and some of the questions around that, but nonetheless, people do take a look at it. Joining us now, I'm so pleased to say, Nationwide's Kathy Bostancic and Alberto Gallo of Andromeda Capital Management. Kathy, what do you make of yesterday's data in particular? I really want to start with that and how much that has sort of forward-looking indications of goods prices starting to really, I don't know, go up, reaccelerate.
Yeah, good morning, Lisa. Happy to be with you. Yeah, I think, that's, something that's quite interesting because goods prices, as you know, have really been the positive factor here in the inflation story, and have actually the latest data sort of suggested, when you look at CPI, that is, that we had further deflationary pressures. If that starts to temper or we see some uplift, that could really, change the story here. Goods, gasoline prices, obviously headline inflation, very sensitive to that. And the reason that, again, matters is that we still have this ongoing stickiness in the service side of the economy, whether it's core services or also looking at rental inflation.
And Kathy, this is the reason why people are talking about whether there is some sort of restrictiveness currently in the system. Alberto, you wrote a fascinating note about this, just how restrictive Fed policy actually is and how it's sort of, I don't know, a mirage that they're using front end of the yield curve to try to seem like they're restrictive, but they're really not so much. Please explain, because to me, this is fascinating at a time where people are pushing back their expectations of a rate cut.
Good morning, Lisa. Essentially, what we're talking about is the Fed trying to perform a magic trick. They have focused the audience attention on the front-end rate, and they've raised front-end rates by 500 basis points. But on the other hand, what they're doing is to reducing the pace of tapering, and they've reduced it by more than expected. So the Fed balance sheet is still, very large, and it hasn't really fallen since the peak. At the same time, there's also a lot of fiscal and there's indirect QE. For example, the bank term funding program has allowed banks to fund cheaply to buy treasuries. So, they're hiking with one hand, they are not hiking with the other. The result is that there is a record loose financial condition. So we definitely don't see any restrictedness in financial conditions right now, unless you're a weak household and you're funding with credit cards or auto loans, so you're depending on the front end rate. But for large firms, for whoever funds in the bond market or long-term mortgage borrowers, funding conditions are still pretty good. And that means persistent inflation. It means that there's rates volatility, and we are a lot more worried about reacceleration in the economy or persistent inflation, hurting the rates market rather than the recession that, every economist has been thinking about for the past 3 years.
Well, Alberto, we got a fresh call from Goldman Sachs this morning saying that they now expect a cut to be in September. Initially, they were talking about, most recently, they were talking about July. What do you view in terms of the timeline, given what you're saying about the policy not being so restrictive?
I think here the trade is for next year. Yes, we might have one cut this year. Our forecast is still for 0. But the reality is there's still a lot of cuts that are priced in for 2025. And I think that is wrong, especially with the outlook that we have for elections. We're going to have a lot of fiscal stimulus next year, regardless of who wins. But, there are some scenarios where there's even more fiscal stimulus than the CBO is expecting for next year. So we have persistent fiscal. And, the 80 plus basis points cuts that we are seeing in the market for next year are not going to happen in our view. So, yes, we might have a cut, but it's going to look like a policy error in our view. And, even other central banks are starting to change the narrative. So we need to learn to live with higher for longer. And there's a lot of asset allocation that has been centered around the expectation of lower rates. And that's going to have to reprice.
Kathy, I know you also think cuts could be delayed in a certain scenario till 2025. But Alberto there is talking about potentially the fiscal impulse we'll also get in 2025. How much harder is that going to make the Fed even to cut next year?
Yeah, I'm not so sure we get a lot of fiscal stimulus next year. Certainly, if we do, then that would delay, or dampen Fed rate cuts. But I think, from my perspective, we are seeing some moderation in economic activity. Right now, it's just the first step, and there's a long ways to go in terms of economic activity and also inflation. But we're still hopeful that we do get some further drop in inflation, particularly if we think rental inflation. But the problem is it may be brief, right? Because we've seen some signs of rental inflation picking up and home prices picking up. The problem is there's long lags, right? Typically it's about 12 months. This time it seems to be longer. But so we're hopeful that we do get further cooling in inflation. I think that's really what matters most for the Fed. And I would agree with Roberto. There's like a tale of two economies going on right now. If you can come to capital markets, you're a large corporation, and you termed out your debt, you're in pretty good situation. But if you're a small business, or if you're a middle income household or lower income, you're a variable rate borrower, you are feeling the pinch. And I think higher rates have had an impact. Look at the housing market. The existing home sales market has been essentially stalled.
And that's potentially part of the reason that small caps, for example, haven't kept up with the gains. Alberto, in this idea that policy is easy, not just because of the fiscal, but because of QT2, the Fed would say to that they are slowing the drawdown of the balance sheet, not because they want to ultimately not draw down as much, but it allows them to do it for longer and potentially ultimately get to a lower level because they can keep drawing down without the risk of any financial accident. What would you say to that?
Well, the first phase has been very easy for central banks because inflation came down thanks to an easing of supply constraints, and also we had a very strong inflow of immigration, of relatively cheap labor. Now, these one-off positives are going to fade. So the first phase of disinflation has been much easier. Now it's, the hard part is what's ahead of us. So we have, less flow of immigration, and we actually have, still supply constraints that are persistent. And there are some feedback loops. So the idea of keeping the balance sheet very large and making it come down very slowly, in theory, looks good. But in practice, what it does is that it keeps financial conditions loose for a large chunk of the economy. So there's no real tightening for large firms, for mortgage borrowers that are long-term. And so I think that the result of higher front end, but also persistent fiscal and a persistently large balance sheet has been that financial conditions are not as restrictive as the Fed thought they would be. And the narrative is changing. The narrative is changing. I think that some Fed presidents are already taking that into account, which means that you won't be able to do a lot of cuts. But the other consequence is that eventually some central banks will have to choose between price stability and financial stability. So it is true that it's really good to not cause any issues in the financial market, and no one wants it ahead of elections. But the mandate is also price stability, and I think that there's been a lot of micromanagement of volatility from central banks. We see it in the allocation of risk assets. We see it in the love for credit and for carry that there is in the market right now. We're at record tight spreads, and investors, are essentially ignoring this front end 5% rate because the long end is inverted.
Kathy, would you just say to that Alberto's wrong because it's just a lag? That's actually what we're seeing, not that policy isn't tight enough?
Well, I have some sympathy to Alberto's comments. I mean, certainly financial conditions are easy. Part of that's because the equity market continues to rally so much, and we do have an inverted curve. But long-term rates are higher. I think in terms of the thing about mortgage borrowers, they're still looking at 7% rates. That's quite draconian, especially compared to where we were. And I think some corporations, if they have to come to market and roll over their debt, they are facing higher refinancing costs. But in general, yes. I mean, if you're an asset holder and you're a corporation that has a lot of cash and you termed out your debt, the short-term interest rates are not biting as much as the Fed had thought previously. And I think that is key. And I can see the Fed holding rates higher for longer, and possibly, if need be, would raise rates higher. So I have sympathy to that. I think it just really does depend, though, on inflation. If we start to see inflation trend lower, then the Fed will have the green light to start cutting rates, especially next year.
On this show, just a couple minutes ago, we were talking about deflation, and we were talking about deflation when it comes to gasoline prices. In particular, we had this discussion around the average price going down to $3.29 from the current $3.61 in the United States. Michael McKee is still with us. Mike, I wanted to talk with you about how important that is from an economic perspective, from consumer spending, from what this does to the package of household budget that can go to other things. How stimulative, essentially, would it be if gasoline prices go down significantly?
Well, the change that we've seen so far isn't that significant. What you usually see in terms of gasoline prices is when they go over the previous high, that's when people start to pull back and get nervous because it's something that they really notice. Slight changes, 10, 20 cents either way, they bother them more on the upside. But it hasn't had an impact overall on spending in a while because gas prices have been sort of in this range for some time.
Well, and this is a reason why, Kathy, a lot of people were looking at this expectation that we were going to end up with a really crimped consumer where you had savings running out and you had some of these inflationary pressures, people talking about a commodity shock. None of it materialized. So where are we on that? Do we have a consumer that has run out of savings and is increasingly strapped? Or do we have a consumer that can tap leverage, that has plenty of capacity, and particularly at the higher end, still tons of money?
Connection lost.
So I would say more in the former camp, Lisa, is that I do think large portions of the consumer sector is tapped out. They have run down, the $2 trillion worth of pandemic-related savings. They've ramped up consumer credit card use, right? And we're seeing, if you look at the New York Federal Reserve survey, 10% of credit card holders are now seriously delinquent. And you see that also with auto loans, delinquency rising. You typically don't see that when the unemployment rate is, less than 4%. That's usually a recessionary sign. So I do think we're hitting some roadblocks for the consumer. But what's going to matter most is employment growth and wage growth, right? I think now the consumer is really dependent on current income stream to fund spending, and the savings rate's at 3.2%. There's not a lot of extra buffer there for the consumer to run things down.
Alberto, final word?
I think there's some weakness. There's a little bit of cracks opening across the weakest part of the employment market and the credit market too, but it's not enough to create the conditions for a lot of cuts. And in the meantime, outside of the US, we see China stimulating, Europe spending. So, global financial conditions are very loose. Commodity prices are going up. We're still, much more worried about the right tail. So things going too well versus the left tail, which is the typical recession risk. So, we're going to see more vol in rates, and maybe we'll retest the highs in yields throughout the year.
Nationswide, Kathy Bostancic and Alberto Gallo of Andromeda Capital Management. Both of you, thank you so much. Have a wonderful long weekend. Right now, let's get you an update and stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. JP Morgan will have to pay $100 million to settle a multi-year probe into the bank's trade monitoring. The CFTC said that JP Morgan failed to properly monitor billions of client orders between 2014 and 2021. Staff at the bank found significant gaps in its surveillance of trade data that were not monitored across at least 30 trading venues. In a statement, JP Morgan said, quote, significant remedial actions have been taken and that the surveillance gaps were resolved last year. Meanwhile, a good day for NVIDIA CEO Jensen Huang yesterday. His net worth growing by almost $8 billion to $91 billion as shares of NVIDIA rallied 9% after reporting better than expected quarterly results. A majority of Huang's net worth comes from his stake in NVIDIA, the company he co-founded back in 1993. Huang is now the 17th richest person in the world, according to the Bloomberg Billionaires Index. And as Anne-Marie mentioned, Goldman Sachs is pushing back expectations for the Fed's first rate cut. Chief economist Jan Hatzius is now betting the Fed will cut in September rather than July. A new note to clients says recent PMIs and jobless claims will not give Fed officials the confidence needed to lower rates. The note went on to say a second cut is expected in December. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, setting your week ahead for the day, for the week. We get a sense of what's going on. You are watching Bloomberg Surveillance.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis.
Big dogs. This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Welcome back. This is Bloomberg Surveillance on the last day before a long weekend, counting you down to the opening bell. Here is your trading day, setting you up for the day and the week ahead. At 10 a.m., we'll get University of Michigan consumer sentiment data. The Treasury market closing early at 2 p.m. ahead of the long Memorial Day weekend. U.S. and U.K. markets are both closed on Monday. We're still trying to figure out why in the U.K., a bank holiday. Tuesday, we'll get consumer confidence data ahead of U.S. GDP and core PCE on Thursday. Personal consumption very much front in focus. Jay Pulaski of TPW this morning, very much in the Dan Ives camp, saying, don't sweat the details.
Most people talk about us being late cycle going into recession. That's been the thesis for the last 18 months. People still have it, even though it's been wrong for 18 months. So our feeling is that we're early cycle. We're in the beginning of a manufacturing pickup. We're in the beginning of a CapEx boom to build out all the things we spent time talking about earlier this morning. And that, for us, leaves us constructive. So we don't sweat the detail.
Jay definitely is feeling good because he's gotten a lot of calls right this year talking about artificial intelligence and the tripolar world. Emory, you picked this out in particular, this idea that he thinks geopolitical risk is frankly a buying opportunity because it never comes to pass in markets. What are you sort of looking at on that sphere?
When I think people talk about geopolitics, I have to go back to what happened with Russia's invasion of Ukraine. This idea, this sentiment, Angela Merkel led part of this, that the more you integrate potentially adversaries into your economics and finance, the more likely there could be peace. Think of Europe's reliance on Russia. But in 72 hours, we saw a lot of that fall apart. So that's why sometimes I pick holes in some of Jay's thesis.
Well, and he was up for the debate. He said, have me back when in 6 months, and we'll discuss once more. After all of that, all of the conflicting kind of views that we heard there, we heard some people talking gloom and doom about Lee Farage in particular, rate hikes really torpedoing some of the strength that we've seen in stocks. We heard Jay Pulaski going full bull. Emory, what kind of stands out to you? What's your final thought?
Well, I'm looking ahead to the University of Michigan sentiment. I want to know where the consumer, the American electorate is on inflation, even if I don't always trust the data. And this sparked my attention today from Paul Donovan over at UBS. Politicians weaponize economic statistics, particularly at election time. To paraphrase that iconic economic resource, The Princess Bride, the voters' response is often, quote, "You keep using that data. I do not think it means what you think it means." Economic data does not win votes. People are not feeling good about the economy, even though, to Danny's point earlier, Biden will come out and say the data is showing that the economy is doing well.
Which is a reason why you heard Janet Yellen saying, basically, inflation is too high. I understand how people feel. We've got to do more. We're doing our best. We've made some progress, trying to toe that line between basically heralding progress, but also talking about just acknowledging what people are feeling. Danny, what's your takeaway? I mean, basically, we're hearing about AI is going to save the world, and every robot under the sun is basically going to make us all richer, better, and thinner. And then you've got other people saying, just hold on a second. We haven't killed the business cycle.
Yeah, well, it's clearly not going to save the stock market if you can get a day where NVIDIA rallies nearly 10% and the rest of the market, albeit by a small amount, is down. It's this philosophical debate that I think is really interesting. Is AI going to give us the productivity boost that the 90s saw? And even here, Lisa, we had two very different opinions. You have Ian Shepherdson saying that, no, it's not, because the rollout of that, it's not like the internet where everyone can just go online and sign up for a website. It takes time to incorporate AI, whereas Jay Plosky basically saying, the infrastructure is there and it's being built up really rapidly, and we're underestimating the impact it's going to have.
I want to say, ChatGPT, what's the argument to have me come back to the office? And maybe that could sort of help productivity.
You know, say, stay at home because I want to take your job, Lisa.
Coming up on Tuesday, RBC's Lori Calvasina, Jane Foley of Rabobank, Michael Purvis of Talbackin, and Pooja Sriram of Barclays. Danny Berger, thank you so much for spending 3 hours with us. Have a wonderful weekend. And Marie, Danny, both of you, good luck in your travels and in the lines. You can report back whether you had clear or not and what your experience of it was. Right
Clear
now,
and TSA.
You've got
to have both. You have to have both.
Fully loaded.
You basically walk in, here I am. This is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From New York City, for our viewers worldwide, I'm Katie Greifeld in for Matt Miller. You take a look at S&P 500 futures right now, trying to rebound from yesterday's losses, but still on track for a weekly decline. The countdown to the open starts right now. Coming up, futures edging higher as stocks flirt with their first weekly decline since April. Another equity strategist sounds the alarm while another economist pushes back their rate cut forecasts. And Treasury yields in focus ahead of a big week of U.S. economic data. We begin with the big issue. Earnings season starts winding down.
The reality is that earnings are coming in better than expected because we have a strong economy. And as long as that's going to continue, stocks are going to be fine. And so when you look at Q1 results, earnings estimates going forward, the next 12 months have been raised to an all-time high. We're not sweating the Fed cutting, June, September, whenever. We're not sweating those issues. We're focused on the fact that earnings are solid, and that gives us the comfort to continue to stay fully invested.
Joining us now, we have Nadia Lovell. She is UBS Senior U.S. Equity Strategist. And Nadia, we're going to get to earnings and, of course, what comes after earnings. But actually, I want to talk about what happened yesterday. It was really interesting. You had NVIDIA finish the day 9% higher, but even still, the S&P 500 closing down 0.7%. You think about the week that was, tech is the only sector higher on the week. What does that say about breadth in this market right now?
We continue to think that breadth is broadening out and improving. And yesterday, of course, the last couple of days, sort of the good news is bad news did reinsert itself, just given the ongoing concerns around inflation. And it's not too surprising to see investors take a little bit of risk off the table ahead of the long weekend, particularly after the fact that we've had such a strong rally over the last several weeks. I mean, at the end of the day, we have a market that's up 6% since late April, and nearly every sector is in the green. But overall, we do think that the macro backdrop does remain supportive for equities. And so we would expect this rally to continue to broaden out. And of course, that has to do with the earnings environment, which I know you'll get into.
Well, is that the key here? You mentioned the macro backdrop, supportive for risk assets, but then you think about the fact that we're at the tail end of earnings season, and by most measures, it was pretty good. You didn't necessarily see that reflected in the one day after performance, but you think about that battle between the micro and the macro. Is it still the macro dominating things?
Well, we're now with the earnings season, as you noted, is behind us. But we came away from the earnings season incrementally more positive. I mean, you have corporate growth that is broadening out. You're seeing upward revision to the estimates. And we think that this year you could see an S&P 500 that has earnings growth of about 11%. Of course, the larger companies are continuing to dominate that in the first half of the year. But as you get into the back half of the year, into the end of the year, we think that that gap will really narrow. Now, we're sort of in somewhat of a news vacuum, given that earnings season has wrapped. And so the market could be a little bit bumpy and more sensitive to the macro data, particularly as we get core PCE next week. But I do think that this market will continue to move higher, and we expect this market to touch 5,500 this year, supported by the earnings growth.
Well, you mentioned those big companies, so let's meditate that on that for a little bit longer, because you think about the earnings season that was, and it just seems like tech was the all-star outperformer, capped off by NVIDIA, and it almost seems too easy that really you just let your winners run. You bet on tech. You continue to watch that sector outperform. Is that the playbook here?
It's not the play, but we do have a preference for tech, but we also have a preference for industrials. And even if you look at the strong performance this year, you're also seeing utilities catching a bit. So while tech still is on the leaderboard, at the top of the leaderboard, you are seeing other sectors really start to participate in this. And if we get this cyclical pickup that we expect, the recoveries that we're seeing in PMIs, that should help fuel the broadening out in some of the other cyclical areas, whether that be financial or industrials, and like I said, even like utilities, which is more defensive, as interest rates starts to come down, which we do expect them to moderate. Even those defensive sectors could get a relief from a lower interest rate environment.
What's the narrative around utilities right now? Because you think about the narrative for big tech, it's easy, it's AI, but I've seen several people make the call that utilities are also an AI play at this point. What's actually going on with that sector?
You do have those undercurrents in utilities. So yes, the recent rally that you've seen in utilities is to the benefit of those names that are AI exposed, on the premise that there is going to be increase in demand for electricity as data centers get built out, and utilities as sort of at the center of that. I mean, some of the bottlenecks that you're seeing in the AI build out is really coming from industrials as well as utilities, the ability to get power down over the longer term to some of these data centers. Today is not so much of an issue, but it's looking forward a couple of years from now that we will need to add capacity to meet that surge in demand for AI.
Well, Nadia, hang tight for just a couple minutes, because you mentioned the fact that it seems like good news, bad news once again, and we did get some fresh economic data out of the U.S. this morning. So let's get to Bloomberg's Mike McKee for a breakdown. You think about what we learned with durable goods. It certainly looked like good news.
It did, and we saw the markets react to it briefly. Maybe they're waiting for the Michigan survey numbers at the top of 10, or maybe just everybody's off for the holiday early or something like that, because we kind of gave back a lot of the changes. The durable goods orders, as you mentioned, do come in higher than anticipated, up 0.7%. I guess you'd call that significantly higher, because the forecast was for an 0.8% decline on the month. Capital goods orders, non-defense ex-air, up 0.3 after a negative 0.1, and that previous number graph I was showing you, it shows you why people don't put a lot of faith in the durable goods numbers, because they are so heavily revised. But for right now, it is relatively good news, and that may be why economists are marking up their forecasts for the second quarter. We have the latest Bloomberg Economist survey for the year out, and for the second quarter, they see growth coming in at 2.2% in April. They were looking at only 1.6%, a lot of that driven by business investment, 1.9% up. PCE prices come in a little bit higher, economists think, but unemployment is unchanged. Now, as we set up for the weekend, y'all can pay no attention to the markets and the economy for 3 days. Then we come back next Friday, April PCE prices, April income and spending. PCE, obviously the big one for the Fed. The Fed blackout period begins on June 1st. You'll be glad to know that for 12 days we will not have any Fed speak. May jobs report on June 7th, and then the May CPI is the same day as the Fed meeting. So those inflation numbers, the jobs numbers, will be key, but except for any late speak on Friday next, there won't be any influence on what the Fed is thinking, at least any public comment on what the Fed is thinking about those releases.
And of course, I think a lot of people have already started their weekend. It's a good point there. But we actually did get a really interesting note out of Goldman before that long weekend, basically pushing back their first Fed rate cut call to September from July, writing that earlier this week. We noted that comments from Fed officials suggested that a July cut would likely require not just better inflation numbers, but also meaningful signs of softness in the activity or labor market data. Again, using that as a reason to push back that cut call. And it certainly feels like Goldman isn't alone in reading what the Fed officials have said and then pushing back some expectations, Mike.
Yeah, that's pretty much the case. Everybody's joining in this pushback idea, and we have the same thing showing up in the Bloomberg Economist survey. People think November, December is much more likely for a first cut. Just not enough time for the data to go the Fed's way in July.
All right, well, Mike, enjoy the long weekend when you get there. But before we get there, let's go back to Nadia Level of UBS, still with us. And let's talk a little bit more about the Fed, because it seems like every economist across Wall Street has pushed back their expectations for a rate cut. But then you take a look at Deutsche Bank saying that the stock market, it can thrive even without a rate cut. Even if the Fed didn't cut at all this year, things would probably be okay. Is that your base case as well?
That is our base case, that you don't need a rate cut to have the equity market continue to perform. I mean, if you look at the Fed's futures market, it's sort of been back and forth between 1 and 2 rate cuts. Our core thesis is for 2 rate cuts this year, starting in September. I mean, what you have heard from the Fed consistently is this is a data-dependent Fed, and one that needs more confidence and will have patience. We heard that all week. It seems like everyone was singing from the same hymn sheet and leaning more hawkish to the higher for longer sort of narrative. I mean, Chairman Powell did try to remove the possibility of a hike from the in the press conference earlier this month, but clearly the minutes sends a different message. But we do think that when you get core PCE next week, you will see progress on inflation. We're looking for 0.25%, and year over year, that's 2.7%. So again, it's still above the target, but not far from where the Fed wants it to be by the end of the year. So we think that by the time you get into September, progress made on inflation, labor market is softening but still solid, that the Fed will have enough data in hand to start to ease.
So maybe this stock market rally, it doesn't need a rate cut, but if the Fed were to hike rates, if they actually did have to lift rates beyond where we are right now, what would that mean for bulls?
It would create a headwind from a valuation standpoint. We have forward PE multiples that are over 21 times. We also have some areas of the markets that are particularly sensitive to the interest rate environment, not only from a sector standpoint, but also from a size standpoint, particularly small cap. So you could see some weakness in that if the sort of higher inserts itself again. But we think that that is a low probability. It's not a 0 probability, but highly unlikely that we think that will happen. But if that does happen, it will cause some volatility in the market, and some areas of the markets will likely sell off.
So low probability, but not 0. Nadia, before I let you go, I do want to talk about your year-end target for the S&P 500, recently upgraded to 5,500. You take a look where we're trading in futures right now, currently around 5,300, so not too far away. What does the course of the rest of the year look like? Is that a straight line to 5,500, or what sort of volatility should we be preparing for?
That's a great question. And as we all know, it's never a straight line. And that's the ultimate question, is sort of like, what's the cadence of that? We wouldn't be surprised to see, the market sort of move sideways until there's a little bit more clarity in terms of the data around inflation and also the Fed's reaction function. But that said, ultimately, we think that the earnings is what's going to win the day. If the economy remains strong, which we think that it will. I mean, we're looking for, slightly over 2% GDP growth this year. And the consumer still remains in good shape, despite the fact that you're seeing some weakness on the lower end, but nothing too alarming. So we think that that should be supportive to corporate earnings. And we think that the markets will move higher, not without some volatility along the way. And we think that the next earnings season should be a good one, and that will help push the market up to 5,500.
Nadia, happy Friday. Really appreciate your time on this Friday morning. That is Nadia Level. She is Senior U.S. Equity Strategist at UBS. And joining us now for a look at the stocks moving ahead of the opening bell, here's Simone Foxman.
Hey, Katie. Yeah, Workday shares now down in the double digits. This after the company cutting guidance on subscription sales. This is on pace for its worst drop since March 2020. The CFO blaming this on sales scrutiny, especially in EMEA. Also lower headcount growth among its customers. Piper Sandler says this is clearly disappointing. But on the upside, we're looking at Ross Stores, which boosted its earnings per share forecast for the year. This mainly about cutting expenses. The CEO says they hope to do better. However, Citi says this was a better results than feared. And finally, Lucid, the EV maker, in a filing today saying it would eliminate about 400 jobs by the end of the third quarter. That amounts to about 6% of its workforce. Just another sign of the stress in the electric vehicle market. Remember that Tesla also talking about cutting jobs and some uncertainty there, Katie.
Simone, thank you. And on that note, coming up, Elon Musk says he's up for Chinese competition.
Tesla competes quite well in the market in China with no tariffs and no differential support. In general, I'm in favor of no tariffs.
More on Tesla next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Neither Tesla nor I asked for these tariffs. In fact, I was surprised when they were announced. Tesla competes quite well in the market in China with no tariffs and no differential support. In general, I'm in favor of no tariffs.
And that, of course, was Tesla CEO Elon Musk speaking at the Viva Tech conference in Paris. He also remained non-committal on building a low-cost Tesla EV. And of course, it's been a rough year for the EV maker. Disappointing sales numbers have caused the stock to dip almost 30% so far this year. And joining us now is Bloomberg's Craig Trudell. So Musk, he was coy on multiple fronts. Let's start with tariffs, though, in favor of no tariffs. But how much of an existential threat would cheap Chinese EVs be to Tesla if they actually did come stateside?
Yeah, I do think that it's the case that we don't necessarily have to worry about that threat. We seemingly didn't need to, even under Trump's tariff rates, and now that the Biden administration wants to take the tariffs north of 100%, companies like BYD just aren't coming to the U.S. market. And that being said, I mean, we're already seeing the effects of just how stiff a competition a company like a BYD is for Tesla, and that they've been losing substantial market share in China. And Musk, sort of put a brave face on the state of Tesla's business in China, but they have been losing quite a bit of share. And they've moved, from a approach of having a factory largely for the local market to, transitioning for that to be, their export base globally. And so, the Model 3s that are sold in Europe are largely, coming from China. So this is a case of trying to kind of, separate this idea of just how competitive the Chinese are from whatever Tesla's up to. And that was what Musk was trying to do yesterday.
So we're going to get to a potential cheaper model of Tesla, but let's talk about their existing models and what levers do they have to pull when it comes to pricing? Obviously, we've seen some massive price cuts coming on existing models, but how much juice is left there?
Yeah, they don't have a ton further to cut, and still sort of preserve the margins that you would like to see if you're an investor in the company. That was part of the draw here, was that yes, you had the tech potential for this company, but also I think investors generally got used to this idea of that this was a car company with industry leading margins, and that is not a claim that Tesla can make anymore. And I think we're absolutely in a position now where rather than bringing a brand new car to market, people often refer to it as a Model 2. What they're going to try to do in terms of a lever, next here, is to take the work that was being done on that vehicle and apply it to the existing lineup and potentially be able to offer, a lower price version of the Model Y and maybe the Model 3. It remains to be seen just how excited the market will be about that. We definitely saw an indication that it was what they wanted to hear when Musk, sort of danced around the issue and generally referred to this being their plan on the last earnings call, and we had a big pop in the stock. But that being said, that was after the shares really taking it on the chin, and we haven't necessarily seen that run up continue with momentum.
Well, Craig, to that point, what do investors want here? I mean, with shares down 30% year to date, it seems like expectations and sentiment pretty low at this point. What would actually breathe some momentum into the stock finally?
I mean, I think they need to get the fundamentals going to some degree. They need to sort of staunch the bleeding. They need to grow again in short, and it's going to be really hard for them to do that with the existing lineup. And that's why I think investors are really nervous about the plans that Musk has been sort of laying for this company, because he wants to take them in the direction of a robo-taxi model, which is entirely unproven, something he's been talking about for years and failed to execute. And he's not alone in that either. Google and Cruise, the General Motors self-driving unit, it's proven to be a really tough business. It sounds great on paper. It seems like it could be a real sort of money spinner, putting cars out on the road that don't have any humans in them. But there's an awful lot of technology development that needs to be done. And at a moment's notice, you can fall out of favor with a regulator and have to pull your cars off the road. Look no further than what's happened at Cruise lately.
Yeah, real boulevard of broken dreams there. Our thanks, of course, to Bloomberg's Craig Trudell. Now let's switch gears and talk about the banking world, because a number of banks are ordering staffers to report to offices 5 days a week. Here with more is Bloomberg's Michael Moore. And Michael, let's name some names here. Citi, HSBC, Barclays, calling people back.
Yeah, and these are banks that had been more flexible than, the JP Morgan or the Goldmans of the world. And what's driving some of this is there was kind of a pause on some U.S. regulations around monitoring employees, mostly in the investment banking and trading world. And those, COVID pauses are sunsetting now. And the regulators have put in some practices that would allow people to work from home. But a lot of banks we're seeing are deciding that compliance headache is just not worth it. So they're instead calling employees back. And we've seen a number of banks so far. Others are considering it before things start to change in July on some of these policies. So we could see others follow suit.
Well, just quickly, 30 seconds. I mean, further apart, FINRA has come out and said, this isn't our fault.
Yeah, FINRA is saying, things are changing, but we have set up policies that would allow these banks to have people work from home. It's just a matter of whether the banks find that flexibility worth the costs and, time put into making that happen.
All right, Bloomberg's Michael Moore, thank you so much for that update. Coming up, the morning calls. And later, we're going to discuss the state of the consumer with Joe Feldman of Telsey Advisory Group, of course, as earnings season wraps up. This is Bloomberg.
was going to keep rate World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
All right, it's time now for morning calls. And first up, we have Wedbush raising its Apple price target to a street high of $275, pointing to strengthening iPhone demand and potential upside from new AI technology. Next up, Wells Fargo upgrading DuPont to overweight, expecting the shares to benefit as the economic recovery accelerates. And finally, we do have Mizuho upgrading NXP Semiconductor to buy, highlighting the chipmaker's improving fundamentals. Meanwhile, you take a look at futures right now. We are still in the green. The S&P 500 higher by about 0.3% in the pre-market. Of course, just about 4 minutes away from that opening bell. You take a look at the bond market, seeing a little bit of a sell-off. Yields marginally higher when it comes to that 10-year Treasury bond. Coming up, we're going to speak to Joe Feldman of Telsey Advisory Group at the opening bell. That conversation coming up next. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
countdown to the open. I'm Katie Greifeld. Moments away from the start of trading, we have green on the screen behind me. You can see the S&P 500 currently higher by about 0.4%. It's the same thing if you take a look at the NASDAQ 100. Meanwhile, your small caps, the outperformer today, very early, 0.7% higher. Let's take a look at the cross-asset action right now. You can see a little bit of a sell-off in the bond market, just about a basis point higher on that 10-year yield, hovering near 4.5%. The euro camped out at 108, and you can see crude moving slightly higher here, about 0.6% right now. Meanwhile, one stock to watch at the open, Eli Lilly. Some breaking news: the company going to invest $5.3 billion to boost production of a key ingredient in its diabetes and weight loss shots after the explosive popularity of the treatment has caused supply shortages. Simone Foxman has more.
Yeah, Katie, this is an ingredient called terzepatide. It's the main active ingredient in the likes of Zepbound, as well as Mounjaro. And this is to expand a production site in Lebanon, Indiana. Eli Lilly's CEO David Ricks talking about their plans with Indiana Governor Eric Holcomb this morning. This would be the largest manufacturing investment in the company's history. It would entail boosted 200 high-skilled jobs for the facility, things like engineers and scientists, as well as 5,000 construction jobs to actually expand the facility. Interestingly, though, the FDA has said that Zepbound, the weight loss version of this drug, is in shortage, but that's mainly because of the complexity of manufacturing the injectable pens, not the active ingredient. However, the CFO did say back in April that the active ingredient could be in shortage as well if demand continues apace. You know, we just keep hearing from Eli Lilly, as well as their competitor Novo Nordisk, about the continued applications for these drugs. For example, Novo coming out with a study this morning, kidney disease folks 1/5 less likely to die if they take Ozempic. So clearly this demand only looks set to expand, and Eli Lilly trying to position themselves for that, Katie.
Yeah, it might seem like a champagne problem, having more demand than supply, but it's a problem nonetheless. Simone, thank you for that. Let's turn to software now, because Workday cutting its full-year forecast for subscription revenue. Alex Webb has more. Alex.
Yeah, it's a tough day for Workday, looking like it's on track for its biggest decline since 2020. Don't forget, this is a company that makes enterprise resource software. Like, it's how you manage your company in terms of financial planning, human resources, plenty more besides. Now, they beat, actually, on a historic basis on almost every metric, on revenue, on earnings per share, on segment revenue. It was the forecast that was the disappointment, coming in below market expectations, or the high end is in line with expectations, but it could be significantly lower than that. And the reason for this, at least some of the analysts seem to be citing, is actually artificial intelligence. Companies are still spending software money on software for the enterprise, but they are concentrating a lot of that spend towards artificial intelligence. This is not the space in which Workday plays, and therefore that is why it is suffering a little bit more than investors had expected.
Ugly day, like you said, bad day for Workday. Workday so far since March 2020. Don't like to hear that. Alex Webb, thank you so much. Let's turn now to the private markets, because we have to talk about SpaceX. It's weighing the possibility of selling existing shares at $200 billion in valuation. That is according to Bloomberg reporting. Ed Ludlow, of course, has more. And Ed, I don't know if we can call this a mover, but tell me what's going on with SpaceX.
Well, I would say that the secondary market has become unusually liquid, both for SpaceX and OpenAI in the last 12 to 18 months. So SpaceX does tenders every 6 months or so. A tender is where staff, employees, and some early investors are permitted by the company to sell their private shares to outside investors, either existing investors on the cap table of SpaceX or new investors. And the price of that tender round is agreed between basically Elon Musk and SpaceX's CFO and whoever the lead external investor is. SpaceX does not raise any money, no new shares are issued. It's simply a market and liquidity event for the existing shares. And what one source told us is that what's being discussed in this case is a range of $108 to $110 a piece, which gives you the $200 billion valuation. The main point for me is that, yes, SpaceX does a tender every 6 months or so, but its valuation continues to go up. It is no longer the world's biggest startup, ByteDance is the world's most valuable startup, but it is by far and away the most valuable US startup. And there's such close attention to what it may or may not do in the future with regards to an IPO or spin-off of its Starlink unit. So that's why we track it, but we continue to see the valuation climb.
Yeah, it's just amazing. A $200 billion valuation for a private company. It should just go public so that we'd have more to talk about. Ed Ludlow, thank you so much. Let's turn now to the consumer space because Ross Stores and Deckers both jumping on strong results, and Denitsa Seikova is here to break it down.
Yeah, we're seeing very good news from retailers, which target actually very different audiences. If we start at Ross, we actually saw as much as an 8% jump earlier today based on better than expected earnings results and also good news in terms of profit projections. What we're seeing there is that this retailer actually lowered prices for consumers, and this is paying off. We saw comparing sales coming at the higher end of the range. We saw Morgan Stanley boosting their target to 161. Following the results, obviously the brand is targeting those lower and mid-income customers. So potentially we can see that those inflation pressures can be offset when the retailers offer discounts. And in Deckers, we kind of see different trends. Huge increase today, almost 13% based on their famous brands for running shoes, Hoka, which has been getting so much popularity, and analysts are super bullish on it. If you ask Wedbush, they would call it one of the strongest offerings there are. They reinitiated their overweight, and now their target is $1,031. Obviously, the company beat estimates, and analysts are very optimistic about the stock.
And who am I? But I love Hoka's. I've been wearing them since 2015, the maximalist shoe. Just think it's great. Anyway, Deckers shares up 11%. Denitsa Seikova, thank you for that. Let's broaden out this conversation on retail because joining us now, I'm pleased to say, we have Joe Feldman. He is Assistant Director of Research over at the Telsey Advisory Group. And I mean, as you can see in the earnings that we were just talking about, it really feels like a tale of have and have-nots when it comes to the retail names so far this season. What's the common denominator in your sense?
Yeah, the common denominator to us has been that anybody offering value, discount prices, has actually been performing a little bit better. I mean, you look at Walmart last week, really, really strong results. This week, you've seen it from TJX and Ross, as you just mentioned with Deckers. And, wherever there's that value and new innovative product, that combination really seems to work for the consumer. And we've seen consumers trading down to some of those discount operators, but also that core customer has been still staying within that and responding to some of the newness that they see.
Well, I think that's a really interesting dynamic that you are starting to see more of those promotions, basically some of these retailers offering discounts to get that maybe reluctant, maybe tired consumer back in the door. But does every type of retailer have that lever? Who doesn't that work for right now?
Yeah, I think some of the guys that are smart about not pulling that discount lever or the promotional lever are the furniture guys, the furnishing guys. So like Williams-Sonoma had very good results the other day. Their profitability was through the roof. It was really strong, and they did not promote. Demand was a little soft, as it has been across all of the furniture and home furnishing retailers. But all of them have been very disciplined about not promoting. We saw it with our house as well, and some of the others, where they said, you know what? Just cutting the price of the sofa or the bedroom set isn't really going to drive more sales, so let's not do it. So I like that we're seeing that discipline for some of the retailers out there.
So that discipline clearly paying off for some pockets of the retail industry. I do want to talk about the fact that, you think about conservative guidance. It was interesting. We had Elf Beauty yesterday. You had Ralph Lauren delivering what a lot of people on the street said was a pretty conservative guide. And when you think about past economic cycles, periods of high inflation and weakening consumer strength there, is that what we should be expecting to see more of?
Yeah, I think the retailers are smart to be conservative with their guidance. And, we know that the first quarter has basically come in better than feared for a lot of the retailers, if not even just better, like Walmart was, but not getting too aggressive with their outlook for the balance of the year. I mean, we're still, there's this uncertain interest rate environment. We've seen inflation has been coming down, but not to the levels that we'd like to see in some of the services side of the economy. So like that's still putting a lot of pressure on the consumer. And so you have some variables there that keeps the consumer spending in check a little bit. We're still seeing very choiceful spending. And that's why I think the retailers were smart to stay somewhat conservative. Let's not get over our skis here and say we're off to the races yet, because I don't think we are. I think they're also purchasing conservatively too. Inventory is still running pretty lean for most of the retailers.
Yeah, and I mean, to that point you made about that discipline, taking it, not too aggressively. I spoke to Elf Beauty CFO Mandy Fields yesterday. She said that company just taking it quarter by quarter. It feels like that's what you have to do in this environment. But we're talking a lot about the U.S. consumer. Let's go global. Let's talk about the Chinese shopper, because you think about what we heard from luxury, from some of the beauty names, it seems like a common thread there was that the Chinese shopper just still isn't there.
That's right. We're still not seeing the Chinese shopper come back in the terms of the travel to Europe, travel to the U.S. It's a little better in Europe, I believe, but the U.S. travel from Chinese visitors is still not where it should be or where it was pre-pandemic, and that is weighing on the luxury retailers and luxury brands. We're hearing that pretty consistently. As that picks up, that should help, but that whole luxury complex has been a bit soft, and it's been challenging globally, for retail. I mean, we're seeing kind of mixed trends around the globe in Europe and China, and we'd like to see more strength. I think everybody would, and that would help drive the industry a little bit.
What do you make of some of that softness in luxury? Because, of course, we can talk about the Chinese shopper, the Chinese traveler not being there like they have been in the past. But, I mean, the common narrative is that luxury is resilient to most economic cycles. Yeah. Is that still the case, or is something changing there?
Yeah, no, we view luxury as still very resilient. I think, what we've been noticing is it's that aspirational shopper that has fallen off a little bit on the luxury side, especially in the US and in Europe, where, maybe they would, that person that would buy that entry-level Louis Vuitton handbag or something, or a wallet, that's fallen off a bit. The true luxury shopper really hasn't changed that much. They have been a little more choiceful in how they spend. You're still seeing travel spending. You're still seeing them spend on high-end experiences. But, I think that it's that middle or upper income consumer where we've seen some of the pressure. And then you add on, as you just said, the Chinese consumer is not traveling as much and not spending as much on luxury. And that's been really the pressure point. But we think it'll bounce back in time. It's just, we're not there yet.
Not there yet. I mean, you went where I was wondering, and that is the aspirational shopper still out there? In your view, they are. They're maybe just sidelined right now. But talk to me about the full spectrum right now. Let's bring it all together. We talked about some of the discounts that are happening. We talked about luxury. What about the middle? Does the middle just fall out here, and how long does that last?
Yeah, the middle is definitely where you're seeing a lot of pressure. You're seeing people being very focused on what they spend. They're trying to stretch their dollars. That's where you're seeing, like, Walmart benefiting, where they're seeing more customers trade in. The dollar stores are seeing that. The off-pricers are seeing that as well, where customers are trading down. They're still shopping, but they are looking for value. They're looking for discounts. They're buying more private brands from the retailers directly. Smaller pack sizes for a lot of these people. So, like, we're seeing the spend, but just not at quite a robust level. And people are being very choiceful in how they spend. So broadly, the consumer is pretty resilient. It's just we're not seeing that excess spending at the moment. I think people are still watching their pocketbooks just to make sure, where the economy is and how their personal finances are going to look as the year progresses.
All right, I think that's a good place to leave it. Joe, really appreciate your time on this Friday. That is Joe Feldman. He is Assistant Director of Research over at the Telsey Advisory Group. Now coming up, preparing for an Ether ETF.
I think it will be very important because if the SEC approves these, it really undermines the case that they're trying to make that Ether is a security. And so we think it will be very important for these to get forward, and we're encouraged by that news.
That conversation coming up next. This is Bloomberg.
you actually offer a payout at 7 years to encourage people to explore if they don't find themselves in management position? I mean, what's the thinking? I mean, like, what's that about?
We're not forcing everybody to, be kicked out, right?
But you encourage people to explore.
Exactly. We encourage people to think about their, because sometimes it's easier, even for me, if I don't need to change everything, it's easier, right? Change is really tough thing for everybody. Should I do this job for next 5 years, 10 years, or should I try a new thing? If I had to think, that is a great opportunity to think about it. We need to think about what kind of talents I can have for the next 5 years, 10 years. What's the best way to contribute to the world?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
The SEC is probably reading the tea leaves. They realize that it's very hard for them to continue to have this sort of hostile take towards the crypto industry. I think it will be very important because if the SEC approves these, it really undermines the case that they're trying to make that Ether is a security. And so we think it will be very important for these to get forward, and we're encouraged by that news.
Well, the crypto industry inching closer to another landmark, the SEC paving the way for the eventual launch of the first U.S. exchange-traded funds that invest directly in the Ether token. Joining us now is Eric Balchunas of Bloomberg Intelligence. And Eric, I know this isn't full approval. That point has been made to me many, many times. If it's not full approval, what is this?
I would consider it just about full approval. We'll call it 99% approval. We'll leave 1% chance for some complete black swan event, but you have to understand that the group that approved the 19B4 is under the same guidance of Gary Gensler. So he's not going to have one group approve it and another not approve it. I've also heard that the other group that's working on the S1s that are not yet approved, they're working on approving them. They're going to give comments probably very soon. There could be 2 rounds of comments. So we're thinking that the S1s get approved between 4 and 6 weeks from now. So we might be looking at a late June, early July launch of these ETFs. But we see no reason that there wouldn't be approval. So I think sometimes people like to get stuck in the technical side of it. And remember, this was a top-down 180. So it's not like one group in the SEC is going to rebel and not approve it.
Yeah, I think we are deep in the technicals here. Of course, you need 2 things. You need 19B4 approval, you need S1 approval. But leaving that aside, like you said, we're 99% of the way there. And let's talk about what the future could look like, because you think about the spot Bitcoin ETF launches, I think everyone underestimated the demand that we would see for those, just billions and billions of dollars pouring into that space. Could we see the same situation here? What's your expectation for demand for these spot Ether ETFs?
Yeah, my metaphor all along has been this is like the opening band having to follow the headliner. I think Ether is going to be 10, 15% maybe of the assets of Bitcoin ETFs. That said, that's a decent amount of a decent chunk of change right there, because Bitcoin ETFs have 60 billion. If you look in Hong Kong, or you look at the futures market, or the futures ETFs in the US or Canada, no matter where you look, Ether has a small fraction of what Bitcoin has. I see no difference here. Another metaphor would be silver. You know, a lot of people who are regular 60-40 investors, they own gold. They don't really feel a need to go buy the silver ETF too. But there are certain people who just like silver. So I think that'll be the same case. I think a lot of people satisfied with Bitcoin being their sort of crypto hot sauce investment. But there definitely will be some who are interested or intrigued in Ether. There will be ETFs that come and combine the two. Those could get some bites. Overall, though, being in an ETF is being like put into prime time. So for Ether, it's all good. It's all additive. But I just don't see them being, you know, more than 15, 20% of Bitcoin tops.
Let's talk about who's who here, because you think about the Bitcoin ETF race, what, 10, 11 ETFs all launched at once. It's a space that's now being dominated by the likes of BlackRock and Fidelity with their new products. Who's in the running when it comes to the spot Ether race, when it comes to the actual issuer side?
Yeah, I would look for a very similar situation. You know, it really does remind me of the Triple Crown, you know. BlackRock, let's call them Secretariat, they're the odds-on favorite to win the next one, right? So if you have a company with a lot of assets and distribution and everybody's going out the same day, you got to give basically the favoritism would be correlated with assets and distribution. So BlackRock, Fidelity, Invesco, VanEck, ARK. I do think, though, that in this case, there could be one or two losers. In the Bitcoin ETF, everybody did well. I mean, even the lowest one was almost 100 million so far, which is a success. This case, I think there'll be one or two duds that just can't survive and probably close, but we'll see. But I'd have to give the odds-on favorite to BlackRock again. IBIT now is about to pass Grayscale GBTC, as you know, and I would think something similar with Ether, just because of their size and their just connection to all kinds of investors, retail, advisors, and institutions. They have a lot. Their tentacles spread far.
Their tentacles spread far. Let's leave it there. Eric Balchunas of Bloomberg Intelligence. Have a great long weekend. And of course, tune in to Eric and myself on ETF IQ coming up on Wednesday. That's 12 p.m. Eastern. It's a lot of fun. But before we get there, let's get some of the sector price action this morning. We're going to do that with Bloomberg's Simone Foxman.
Yeah, Katie, as stocks try to move higher on the day, we're looking broadly at sectors that are higher across the board. Every sector higher, led by consumer discretionary. We continue to get those retail earnings out. And energy and materials up for the day, though it's been a tough week for them. When you look at what's happened this week, the story has been about NVIDIA all week that we've been talking about. And frankly, the story here for Infotech has been strong as well. This is the 5th straight week of gains for the Infotech sector. But if you look down and dive down into the details, you'll see that Microsoft and NVIDIA, those are 2 of the 3 top holdings. They've had 5 straight weeks of gains. On the losing side, however, financials and real estate, tie that to what's happened in yields, this higher for longer narrative, continued woes in the property market, and finally, energy has been bouncing back today after Brent hit a 3-month low, but energy producers and services have been hit. Exxon, Halliburton, both down about 5% this week, Katie.
Yeah, it feels like big tech, your only haven in this market. Simone, thank you. Coming up, the market-moving events you need to be watching. That's next in our trading diary. This is Bloomberg.
This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
It's time now for the Trading Diary. What you need to be watching next week. Markets close in the U.S. and the U.K. on Monday. And then on Tuesday, we get consumer confidence data. On Wednesday, it's the Beige Book. On Thursday, even more retail earnings. Best Buy, Kohl's, and The Gap. And then on Friday, we get PCE, personal income, and spending data. That was the countdown to the open. Have a great weekend when you get there. But tune into Bloomberg Markets coming up the hour next. This is Bloomberg.
The linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. Happy Memorial Day weekend. We have made it to the official start of white pants season. I'm Alex Steele. Paul Sweeney is off today. Mike Regan of Bloomberg News will be joining me. Mike, it's so good to see you. I feel like we haven't had this moment in years.
Great to see you, Alex. I didn't wear my white pants, though. But,
you can't wear it yet.
Not wearing it.
After Monday.
Not till
Tuesday you can.
So confusing.
I feel good about that. The market's pretty much going nowhere fast. We'll get you updated on that. But we have a lot of fun stuff coming up on the show. Ben Emmons of New Edge will be joining us. He has great notes out on AI, Ether, Bitcoin, you name it. Also, we're going to talk about the bird flu with Lisa Jarvis, Bloomberg opinion columnist. This is a thing, and it's happening, and we should definitely start worrying about it. And Eric Edelberg is Bloomberg Intelligence Chief Mortgage-Backed Securities Strategist. If the Fed pushes back those cuts, what does it mean for the mortgage market? But to get it kicked off all on this Friday, let's go to John Tucker with a business flash. Hey, John.
All right, Alex and Mike, we are data dependent, so let's start there. Just crossing the Bloomberg, the University of Michigan data. The sentiment index, we'll start there. This is all Fed-friendly and market-friendly, I'll say that. The current conditions, the sentiment index, first of all, 69.1. That's above expectations, and that beats the prior reading. As far as the inflation expectations, the one-year inflation expectation coming in at 3.3%, and that is less than the prior month. Also less than the expectations in the 5 to 10 year inflation expectation. That came at 3%. That is below expectations as well. And we're seeing the most immediate reaction in yields. The 2-year unchanged now at 493. Following Wall Street's worst day since April, the major stock index is higher. Right now we have the S&P 500 21 points higher. That's up 0.4%, 5288 on the index. The Dow Jones Industrial Average of 57 points. That's a rise of 0.1%. And the Nasdaq 100 up 88 points. That is up 0.5%. Meantime, Patrick Armstrong at Plurimi Wealth says Fed policy is going to take a back seat to company results.
At the start of the year, people were latching on to a Fed that was going to be cutting aggressively, and the markets don't need that, I don't think. It's earnings that really drive markets over the long term, and I think that's where the strength of the market's going to come from.
The other data came earlier today with durable goods. Orders placed with factories in the U.S. for business equipment rising by more than forecast in the month of April. So this indicates firms are still focused on making long-term investments despite an uncertain outlook and high borrowing costs. And among the stock movers, Deckers Outdoor, they own Uggs boots, jumping after blew past Wall Street profit estimates. Those shares right now up close to 12%. And NVIDIA shares today up another 0.3%. We're brought to you by Interactive Brokers. Discover the future of trading with their next-generation trading platform. IBKR Desktop. Download IBKR Desktop at ibkr.com/desktop. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Mike and Alex.
All right, John Tucker, thanks very much. I thought you were off today. Is it Tuesday that you're off?
When am I ever off?
Some days.
I'm here
there's
all
1 or
the
2 days.
Even when I'm not here, I'm
Are
here.
you getting
No, I'm actually, yes, I'm off Monday, Memorial Day, and I took an extra day off Tuesday.
Do you have your white pants ready for Tuesday?
White pants. Oh, that's a fashion thing.
It's a fashion thing, yes.
Yeah.
You're technically not supposed to wear white until after Memorial Day, and you can only wear it
I won't be wearing
through Labor
pants
Day.
because it's the summer. I'll be
Whoa.
wearing a bathing suit. Let me finish. I'll be wearing a bathing suit.
Wow.
Thank you for clarifying that. I mean, I think that shorts also goes with the white and the white shoes, but we'll leave that alone. We're looking forward to that. Okay, Mike, honestly, what are you watching? Because volume is going to be really sad.
Volume will be sad. I'm curious what our guest Vince has to say about these UMISH inflation expectations. I feel like these have taken on such a greater significance than they once did. A little bit lower than expectations. 3% on the 5 to 10 year, 3.3% on the 1 year.
Yep.
So good news for risk, I would assume.
You would think this is the final read for May. And remember, it was the UMISH sentiment that came out and hit a 6-month low, and the inflation one-year expectation hit a 6-month high last time. And that definitely did move the market. So let's set it up with Vincent Signorella, Bloomberg macro strategist, who's probably also not wearing white pants in his studio in his basement. Vince, what do you make of the UMISH numbers?
I'm still trying to get over the feel of John Tucker's legs and shorts. But
To be fair, he did say a bathing suit, but okay.
That's quite a sight, Vince.
I could see Vince in a full white suit, you know, like
totally,
like Miami
100%.
Vice style, yeah.
Yes, but with a white T-shirt underneath. Vince, is this true? Do you own that white suit?
Going back to Fantasy Island there, Mike? No, the UMISH numbers had a temporary boost to equities, and I think the investors are really sort of weighing that against the durable goods orders that we saw this morning. Yet, you have to remember, the sentiment is what it is. It's a sentiment index. It's not hard data. It doesn't usually move markets as much as the hard data does. And with next week, coming up on the 30th and 31st, we're going to get GDP, PCE, personal spending, and personal income. So don't think markets are going to react too drastically to any data we get until then. And right now, we're just seeing markets really, I think, just jockeying for position post the NVIDIA obsession, if you will, and just trying to get their feet under them ahead of a long weekend. Might see a little bit of profit taking, for the guys who were short yesterday. But yeah, go ahead, Mike.
Hey, sorry, Vince. So it's been a while since you and I have chatted. There's two things really I've been dying to talk to you about. One is the yen. I'm old enough to remember when the yen was such an important variable for all of global risk markets and sentiment. We've had this tremendous weakness and volatility that at one point not too long ago would have been the type of thing that would really have roiled markets globally. It's not, though. So is that sort of carry trade influence of the yen just not there anymore? And part two question is, I know you're cooking something good this holiday weekend on your grill. So
yes,
tell us what it is after the end.
Sure. The yen story is kind of conflicted right now because of what the Bank of Japan is doing and involved in moving the interest rates and yield curve control. That's sort of balanced against the haven flows that you would typically see. So the carry trade is still there, but it's not as strong as it once was. You still have a good interest rate differential favoring the dollar, and right now the yen is pretty much moving with 2-year yields. So you see 2-year yields coming off back to a little change on the day at 4.935, and where's dollar yen heading back towards little change. The dollar is still up on the day against the yen, down against the rest of the peers in G7. But that, it's the interest rate differential still driving yen. The haven trade's gone by the boards a little bit for now. But depending upon geopolitical risk, that can come back at any moment.
So what are you cooking on the grill?
Yeah, get to the important stuff. Yeah.
The good point of this is I'm going to my brother-in-law's in Pennsylvania, and so I'm off the hook. He's probably making some filet mignon and stuff like that, and I intend to watch him smoking a cigar and probably chilling with an adult beverage.
This sounds and maybe not in white pants or a bathing suit. So at least
totally. I do not own white pants. I will go on. Nor do I own white shoes outside of possibly sneakers.
Okay, these are important points that we're making throughout the show. Vince, before we let you go, until we get to jobs on June 7th, what's a catalyst you're looking at? You got to pick something.
Yeah, no, I'd go back to where we talked about the data we're going to get next week, which is GDP final reading. I think, it's the second reading for the second quarter. And then I think just as key is personal income, personal spending. The consumer is still spending. I think they're spending on credit largely, though. I mean, the wealthy consumers, have the wherewithal to do that. But I think, the folks who were flush from pandemic infusion are now kind of on fumes, if you will, and trading on credit. We see it in revolving credit. So whether or not the consumer still has that year going where they're still spending, I think is key to where we see economic growth. And if they're still spending and growth is still moving along, we saw a jump in growth expectations from a Bloomberg survey today. The Fed is just not cutting rates. I personally don't think they're going to be cutting at all this year. But we shall see. I think the economy's just a little too hot and inflation's still a little too sticky.
All right, Vince, really appreciate it. Vince Signorella joining us, Bloomberg macro strategist. Enjoy your weekend, travel safe, enjoy that adult beverage and filet mignon. And also, Vince isn't alone, right? Torsten Slok at Apollo thinks we're not going to get any cuts this year. David Solomon and Goldman Sachs raised that at Boston College. We also had Goldman Sachs pushing out their rate cut now to September from July. We're starting to get all that sort of coming through at the moment. Let's get more insight here. Ben Emmons is Senior Portfolio Manager, Head of Fixed Income at New Edge Wealth. But what's so great about Ben is his daily notes, he does 2 a day, are so helpful in connecting different trends to the market. It's not just a fixed income thing. It's more like, here's a trend, here's how it plays in today's market action, which is so valuable to someone like me. Ben, thanks so much for joining us.
Great to be here, Alex. Hey, Mike, good to see you again.
Do you have your white pants and suit ready for post-Memorial Day?
I'm a Miami Vice guy. You know, I was like,
Excellent.
it was Friday night, 8:30, Crockett and Tops. You know, you got your flannel shirt on that my mom made for me.
I can see it. I can totally see it.
Shoes without socks, and yeah, let's go.
We're good. Wicker shoes, they're important. All right, Ben, we just sort of set this up. Vince was saying no cut this year. Apollo says the same thing. Goldman Sachs pushing back their cut. Where are you on this?
So I was on that for some time of like, you know, I think many people realized that 7 cuts was just a really, I think, esoteric type of pricing in the markets. You know, people very quickly rushing on the Fed's language that they are ready to move sooner. And then realizing that, you know, we do have an economy that stays above the trend and isn't really slowing down to that trend. And as a result, you're getting price pressures. And we saw it yesterday in that PMI data, for example. If you get prices paid start to move up even further, there's not much room for the Fed to do anything, really. And that, I think, is the process we're going through. We're just pushing that rate cut further out in the future. Whether it will become a rate hike, that is to be seen, I think. I'm not so in that camp yet, but I think that with this year, we're just going to be unchanged on the Fed funds rate.
You know, Ben, I want to shift gears a little bit because I know you've been thinking and writing a lot recently about artificial intelligence. Mm-hmm. You know, obviously, NVIDIA is the big market story of the year. I'm curious how you're thinking about AI from a macro perspective. I mean, obviously, there is the potential for vast improvements in productivity, but a lot of that type of technology-driven productivity gains can be a little weird when they happen. You know, it could wake up some morning to read about a lot of job cuts because of AI is what I keep bracing for. So how are you thinking about this transition into sort of a really AI-driven economy from a macro level?
Yeah, let's start with investment first. You know, I did some research on the data centers that are being built across the United States. Virginia obviously is the hotbed right now, but it's moving to other states. It's enormous. It's like there's an estimated 250 to 400 billion of investment planned into 2025. There's a consulting group out there that tracks the exactly square meters. We talk about millions and millions of square meters of data centers developed or in the planning. That's, I think, the productivity aspect of AI currently. It's about investment. Then you have, of course, technology companies that are spending on AI. So I think that's fueling the investment and then leading to productivity. What your point is about, you know, once we get this productivity surge, we're going to get automation, we're going to get other things developing that maybe certain parts of labor become, you know, obsolete, so to speak. They're not, you know, being used, and that could affect productivity. I would say, though, that if you go back in the 90s when I started working, they just had rolled out Microsoft with a new sort of like Office version, and the Bloomberg terminal, by the way, at the time was upgraded. And I was sitting there as a young kid like, wow, okay, I was able to navigate much faster than my older colleague. But yet, you know, did that lead to a productivity surge? Apparently, the surge happened the years before, for all the investment that was put into this to get to that point of Microsoft rolling out and Bloomberg upgrading its terminal. I think that's what we're in right now. We're in the initial stage of investing. I think this is part of what the economy is currently reacting to. If you look at durable goods data again today, all the elements about computer chips and computers and all this type of equipment, that's all up in new orders. I think that's what's going on there.
Which I really appreciated your note on Wednesday when NVIDIA did come out, because you talked about how to relate that to, say, the neutral rate. And then if you wind up having all this investment, does that raise the neutral rate? And does it make it harder for the Fed to cut? You have to keep, because it just raises all that growth potential. Can you talk to me a little bit more about that thinking? Because there is a question as to like when that money is really going to materialize with like shovels in the ground kind of thing.
Yeah, exactly. Because, you know, the shovels in the ground will ultimately, I think, affect the economy really significantly, and it's obviously to an extent happening. So, you know, Waller just dropped his speech this morning about the R-star discussion. And think about it this way, right? Like the idea of that the economy is at a certain level currently, say 4%, and the trend says at 2%. So if potential is, say, at 2%, this, what they say, neutral rate should be around that number in real terms. Add on what we're just seeing with inflation expectations, you're actually talking about a nominal neutral rate that's maybe higher, right? Maybe to 4 to 5% range. And if we're then looking at where the Fed is currently, then we're not as restrictive if you compare it to the Fed funds rate where that estimated neutral rate is. Now, where does the company comes into play, or actually the AI really, because that's really not so much the company, it's more the effect that it has on AI investment. You know, one key factor, obviously, we talked about is that if the investment in the economy picks up so substantially, the productivity gains that you get from that, yeah, it does lift potential output. And I think this is the link between something of the AI development that we're seeing to this idea of neutral rate. And I think the Fed has started to acknowledge it, because I noticed in the minutes there were different snippets in there where the Fed members were talking about, like, the enhancements of technology and the productivity efficiencies lead them to think that the economy could accelerate, could improve. And that's where that neutral rate discussion comes in.
You know, Ben, I'm smiling reading your interview notes here because it says Ben does not opine on crypto or cannabis, which is kind of refreshing because I feel like I've heard enough takes on both. But without opining on crypto, though, I would say let's instead talk about meme stocks, kind of the same issue as crypto. This exuberant risk appetites right now, we used to think this was a low interest rate, excess savings phenomenon. It appears not to be the case this time. What do you think's going on with all this?
Yeah, I mean, so in 2021, we had just simply a massive surge of money coming in, and people were trading and doing it all, right? And it affected a lot of different parts of the market. Why the same phenomenon comes back is not 100% clear, but I do think it's part of the environment. We have the VIX being really low. We are, again, maybe in a period where what we experienced in 2006 or 2017, where we had I would call it a dry spell of the VIX. It doesn't move a whole lot, even if the market sells off one day by 2-3%. And I think that has to do with that. The market, I think, is very clear on where the economy currently is. There's not much uncertainty about that. And second, that also ties into that there's probably not much uncertainty anymore about the Fed itself. They can just stay on hold. They don't have to do anything. And lastly, any type of geopolitical tension or political tension that's out there is being viewed as, okay, that could derail this scenario, but it isn't really doing that. So therefore, there's no reason to have any volatility. So I think this is what it's saying.
All right, Ben, we appreciate you. Thank you so much for coming, Ben Emmons, Senior Portfolio Manager, Head of Fixed Income at New Edge Wealth. Just some breaking news from the ECB. Governor Joachim Nagel talking about how the ECB can probably cut in June, but then has to wait till September. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Following Wall Street's worst day since April, the major stock indexes, they are higher right now. The University of Michigan data that we got that at the top of the hour showing consumers tempering their inflation expectations. All 11 major industry groups in the S&P 500 for now, they're higher. In the lead, communication services. The best performing stock in the index, that belongs to Deckers Outdoor, up close to 12%. This is a shoe company reporting stronger than expected fourth quarter sales. This is the company that makes Uggs. Intuit, the worst performing stock in the S&P 500. That right now is down about 7%. The company reported losing 1 million customers who use its TurboTax service for free. The S&P 500, 22 points higher. That's up 0.4%. We're at 5290 on the index. The Dow Jones Industrial Average, 42 points higher. That's up 0.1%. The NASDAQ 100, up 115 points, a rise of 0.6%. And yields have turned lower. The 2-year at 4.93. The 10-year yield right now, actually that's unchanged. We'll call it at 4.46. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. Yeah, that's your Bloomberg Business Flash. Mike and Alex.
Thank you so much. Appreciate it, John Tucker. I was reiterating before the break what's happening over in Europe. So the euro dollar is up. We're at 1.08. And I just want to point out a possible reason as to why here. So Joachim Nagel is a Deutsche Bundesbank president. So he is the ECB participant in Germany. He's a German central banker. That's a better way of saying it, isn't it? So he was talking to Bloomberg, and he had some interesting things to say. He said that core and headline inflation are both decelerating. He also said the ECB can probably cut rates in June, probably has to wait on next move until September. And it just raises the idea that the ECB has made it very clear about June, but they've also raised a lot of questions as to what comes after that point. Whereas the Fed, they've been pushing back kind of when they may cut, but once they start cutting, the expectation is they will continue to do so as a traditional cycle. And that is quite a divergence within the market that I find to be quite interesting. Anyway, there's some news for you on this Friday. Another headline that caught my eye, and it's a fun one. Avian flu, oh yeah, spreads to second farm in Australia's Victoria state. So apparently, Mike,
that's a fun one for you, Alex?
No, it's not at all. Hundreds of thousands of egg-laying chickens are reported to have been culled in Australia's southeast as quarantine measures are put in place to contain outbreaks of highly pathogenic avian influenza. And I feel like we've been hearing a lot about this too in China.
Yeah, and I'm a hypochondriac, so I never like to hear about these things. You know, I'm gonna think I have it probably by the end of the weekend. So.
Right, but it just shows, like, you know, I was emailing Sam Fazeli of Bloomberg Intelligence earlier, and I'm like, do we have to worry about this yet? He's like, not yet. I was like, thanks. That made me feel a lot better. Anyway, I did want to give some time to talk about this. Like, what is the bird flu? What is the avian flu? How do we get it? What does that look like? Lisa Jarvis is joining us, Bloomberg Opinion columnist. She covers biotech, healthcare, and the pharmaceutical industry. She was previously executive editor of Chemical and Engineering News, and she joins us now. Lisa, can you give us like the 411 on like what the avian flu is?
Right. So thank you for having me. It's an infection that, you know, you can tell by its name, primarily has been affecting wild birds and poultry up until now. You know, I think in recent years, we've been seeing a lot more species with evidence that they can be infected. And in the U.S., the thing that's been alarming about this is that we've suddenly seen an outbreak in cows. That's new. We've never seen this species infected before. So for the last few months, increasingly, we're seeing more herds with evidence that there's bird flu in their milk. And, you know, the worry, of course, is that the more that this spreads, the more that this could cause infections in humans, which, you know, we don't want another pandemic at all. I'm sure all of us here.
Yeah, I'll second that, Lisa. One thing that worries me about this story, Lisa, is from what I've read, many farmers are very reluctant to agree to testing to see how prevalent it is. Is there anything that can be done to that? I mean, I suppose you can't really just force a farmer to take a test or have his animals tested. Is there any sort of workaround for that?
You know, I think we've seen in each week a new set of incentives trying to get the farmers to buy in to testing, because you're right, it's very worrying because we don't actually know how widespread this outbreak is among dairy herds. We know, I think as of today, that 9 states have herds that have been infected, but it could be much more than that. Certainly when we see the data showing that there's, bird flu, pieces of bird flu found in milk in states that don't have infections, it worries us. I think USDA has been a little slow in how they've rolled out some of the incentives. One of the things I think that could help is, just making sure that farmers understand very clearly what happens after one of their cows tests positive. One of their worries is they don't know when they can go back to normal operations. And then there's a lot of hesitancy on the part of farm workers, which is very understandable. A lot of them don't get sick time. This is a largely migrant population that may be distrustful. They don't have health insurance, many of them. So there's a lot of challenges to overcome. And I think trying to find ways to draw people into this process is the only way that we're going to know, have a good handle on in real time on what's happening.
Just to be clear, it's zoonotic. It can jump from animals to humans, and then can it go from human to human transmission?
Well, right now, we don't have any evidence that's happening. And in fact, the good news, this is very good news, and we should focus on that piece to feel better, is that the 2 cases in humans we've seen in the US, one in Texas and one in Michigan, are both in dairy farm workers who their only symptom is a conjunctivitis. So likely what's happening is a cow's not breathing on them. They're not being exposed to cow snot. Cows are actually very snotty, I hear. But they're getting this through exposure, likely from the milking equipment, because there is so much bird flu in the milk of infected cows. But that's the thing we want to look for when it gets easier for a human to be infected from a cow, when it gets easier for a human to infect another human. And that's why it's so important to have a handle on the breadth of the outbreak and in real time where infections are happening.
This time of year, I'm pretty snotty myself, so I can sympathize with the cows.
We understand.
Yeah.
It's the allergy season there.
Yeah.
I was interested, though, there was a piece on the Bloomberg this week that shares of vaccine stocks, though, were moving on this. Apparently, Moderna shares were up, Pfizer shares were up. There was a report that companies are in talks with the U.S. government about the development of vaccines for bird flu. Shares of CureVac, for example, they have a bird flu vaccine in early stage testing. Is this just like meme stock hype, or is this a real thing?
I think investors are getting a little ahead of themselves. However, ASPR, which is the kind of part of HHS that takes care of preparedness and manages our stockpiles, did say this week that they had moved the ingredients for making 4.8 doses of vaccines to a manufacturer and to put those into vials so that we would have them just in case. And that doesn't mean that even the just in case would be everybody. Probably if a just in case happened, it would be farm workers. But they also said that they were in talks with Pfizer and Moderna. Now, the good thing about mRNA is that if the virus changed to more easily infect humans, it might be that the vaccine we have in our stockpiles isn't quite the right match. And mRNA, as we know from the pandemic, allows some flexibility there. But I do think folks are getting ahead of themselves and maybe getting excited that there could be a way to fill some of that capacity that no longer is making COVID vaccines.
Lisa, I wonder, obviously for financial markets, inflation is such a big issue still, food inflation especially. Are we at risk of seeing a situation where massive amounts of cows or chickens are slaughtered just to stop the spread of this virus?
I don't think so. Well, certainly with poultry, that's kind of the dairy and poultry industries operate very differently, and poultry farmers are very familiar with bird flu, and they have a lot of biosecurity in place. And part of the reason they have biosecurity in place is that USDA has put a lot of, rules around how they can be reimbursed in order to contain a bird flu outbreak. When it comes to the cattle, so far infections are mild. And so I think what we need to understand is how long an outbreak will be disruptive in a particular herd. It's sort of amazing to think about how many different states cows travel to, dairy cows travel to in their lifetime. And so that I would, the only worry I think, and this is part of the reason farmers have not been participating in testing, to be honest with you, I think is that they can kind of create a backup. But I don't think right now, there's no reason to think that there's a risk to the food supply. I think it's just more just thinking about that movement of cows and how to make sure that we can ensure that that continues to happen.
Lisa, fantastic. You are awesome. Lisa Jarvis, Bloomberg Opinion columnist, joining us on the bird flu and giving us sort of the lowdown on the risks and the non-risks. So do you feel better now, Mike? Or
not at all.
No, he does not.
I think I have it. I think I have it.
Okay, great. You definitely want to spread that.
I will say what we learned from the most epic battle that's taken place on the planet Earth since day one has been the battle between viruses and bacteria. And bacteria have been able to fight off viruses from day one. And we learned so much from them in terms of making new drugs and how to combat new viruses.
And we like bacteria because then we can treat it.
Well, yeah.
Yeah,
this is
so we
true.
like that.
And they do it by themselves, too.
All hail bacteria. This is definitely a Memorial Friday show. All hail bacteria, everyone.
I could
this
keep
is the
going on
takeaway.
this topic.
I know you can, and this is why we love the John Tucker. All right, coming up, Erica Edelberg will be joining us on mortgage-backed security. She covers that for Bloomberg Intelligence. We also have world and national news with Michael Barr.
Thank you very much, Alex, Mike, and John. Despite several severe weather across the country, the Memorial Day travel rush has taken off at airports across the country. Passengers showing up early to their flights in the hopes of getting out on schedule. This man flying out of New York says while he understands the weather concerns, he hopes it won't impact too many trips.
I don't want to fly in hail. I'm sure they don't want to fly in hail, so I mean, there's not another flight for a while, so if it gets delayed a little, that's okay. But if it's straight up canceled, that's going to be a bummer.
Airport officials are predicting nearly 30% more air travel this long holiday weekend compared to last year. The top United Nations court ordered Israel to immediately halt its military operation